be equivalent to the other holdings in regard to the degree of growth which appears attainable in relation to the risks involved. They should also be equivalent in regard to the investor's ability to keep in touch with and follow his investment, once he has made it. However, practical investors usually learn their problem is finding enough outstanding investments, rather than choosing among too many. The occasional investor who does find more such unusual companies than he really needs seldom has the time to keep in close enough touch with all additional corporations. Usually a very long list of securities is not a sign of the brilliant investor, but of one who is unsure of himself. If the investor owns stock in so many companies that he cannot keep in touch with their managements directly or indirectly, he is rather sure to end up in worse shape than if he had owned stock in too few companies. An investor should always realize that some mistakes are going to be made and that he should have sufficient diversification so that an occasional mistake will not prove crippling. However, beyond this point he should take extreme care to own not the most, but the best. In the field of common stocks, a little bit of a great many can never be more than a poor substitute for a few of the outstanding. 2. Don't be afraid of buying on a war scare. Common stocks are usually of greatest interest to people with imagination. Our imagination is staggered by the utter horror of modern war. The result is that every time the international stresses of our world produce either a war scare or an actual war, common stocks reflect it. This is a psychological phenomenon which makes little sense financially. Any decent human being becomes appalled at the slaughter and suffering caused by the mass killings of war. In today's atomic age, there is added a deep personal fear for the safety of those closest to us and for ourselves. This worry, fear, and distaste for what lies ahead can often distort any appraisal of purely economic factors. The fears of mass destruction of property, almost confiscatory higher taxes, and government interference with business dominate what thinking we try to do on financial matters. People operating in such a mental climate are inclined to overlook some even more fundamental economic influences. The results are always the same. Through the entire 20th century, with a single exception, every time major war has broken out anywhere in the world or whenever American forces have become involved in any fighting whatever, the American stock market has always plunged sharply downward. This one exception was the outbreak of World War II in September 1939. At that time, after an abortive rally on thoughts of fat war contracts to a neutral nation, the market soon was following the typical downward course, a course which some months later resembled panic as news of German victories began piling up. Nevertheless, at the conclusion of all actual fighting, regardless of whether it was World War I, World War II, or Korea, most stocks were selling at levels vastly higher than prevailed before there was any thought of war at all. Furthermore, at least 10 times in the last 22 years, news has come of other international crises which gave threat of major war. In every instance, stocks dipped sharply on the fear of war and rebounded sharply as the war scare subsided. What do investors overlook that causes them to dump stocks both on the fear of war and on the arrival of war itself, even though by the end of the war stocks have always gone much higher than lower? They forget that stock prices are quotations expressed in money. Modern war always causes governments to spend far more than they can possibly collect from their taxpayers while the war is being waged. This causes a vast increase in the amount of money, so that each individual unit of money, such as a dollar, becomes worth less than it was before. It takes lots more dollars to buy the same number of shares of stock. This, of course, is the classic form of inflation. In other words, war is always bearish on money. To sell stock at the threatened or actual outbreak of hostilities so as to get into cash is extreme financial lunacy. Actually, just the opposite should be done. If an investor has about decided to buy a particular common stock and the arrival of a full-blown war scare starts knocking down the price, he should ignore the scare psychology of the moment and definitely begin buying. This is the time when having surplus cash for investment becomes least, not most, desirable. However, here a problem presents itself. How fast should he buy? How far down will the stock go? As long as the downward influence is a war scare and not war, there is no way of knowing. If actual hostilities break out, the price would undoubtedly go still lower, perhaps a lot lower. Therefore, the thing to do is to buy, but buy slowly and at a scale down on just a threat of war. If war occurs, then increase the tempo of buying significantly. Just be sure to buy into companies either with products or services the demand for which will continue in wartime, or which can convert their facilities to wartime operations. The great majority of companies can so qualify under today's conditions of total war and manufacturing flexibility. Do stocks actually become more valuable in wartime, or is it just money which declines in value? That depends on circumstances. By the grace of God, our country has never been defeated in any war in which it has engaged. In war, particularly modern war, the money of the defeated side is likely to become completely or almost worthless, and common stocks would lose most of their value. Certainly, if the United States were to be defeated by Communist Russia, both our money and our stocks would become valueless. It would then make little difference what investors might have done. On the other hand, if a war is won or stalemated, what happens to the real value of stocks will vary with the individual war and the individual stock. In World War I, when the enormous pre-war savings of England and France were pouring into this country, most stocks probably increased their real worth even more than might have been the case if the same years had been a period of peace. This, however, was a one-time condition that will not be repeated. Expressed in constant dollars, that is, in real value, American stocks in both World War II and the Korean period undoubtedly did fare less well than if the same period had been one of peace. Aside from the crushing taxes, there was too great a diversion of effort from the more profitable peacetime lines to abnormally narrow margin defense work. If the magnificent research effort spent on these narrow margin defense projects could have been channeled to normal peacetime lines, stockholders' profits would have been far greater, assuming, of course, that there would still have been a free America in which any profits could have been enjoyed at all. The reason for buying stocks on war or fear of war is not that war, in itself, is ever again likely to be profitable to American stockholders. It is just that money becomes even less desirable, so that stock prices, which are expressed in units of money, always go up. 3. Don't forget your Gilbert and Sullivan. Gilbert and Sullivan are hardly considered authorities on the stock market. Nevertheless, we might keep in mind their flowers that bloom in the spring, tra-la, which, they tell us, have nothing to do with the case. There are certain superficial financial statistics which are frequently given an undeserved degree of attention by many investors. Possibly it is an exaggeration to say that they completely parallel Gilbert and Sullivan's flowers that bloom in the spring. Instead of saying they have nothing to do with the case, we might say they have very little to do with it. Foremost among such statistics are the price ranges at which a stock has sold in former years. For some reason, the first thing many investors want to see when they are considering buying a particular stock is a table giving the highest and lowest price at which that stock has sold in each of the past 5 or 10 years. They go through a sort of mental mumbo-jumbo, and come up with a nice round figure which is the price they are willing to pay for the particular stock. Is this illogical? Is it financially dangerous? The answer to both questions is emphatically yes. It is dangerous because it puts the emphasis on what does not particularly matter, and diverts attention from what does matter. This frequently causes investors to pass up a situation in which they would make big profits in order to go into one where the profits will be much smaller. To understand this, we must see why the mental process is so illogical. What makes the price at which a stock sells? It is the composite estimate at that moment of what all those interested think the corrective value of such shares may be. It is the composite appraisal of the outlook for this company by all potential buyers and sellers, weighted by the number of shares each buyer or seller is disposed to bid for or offer, in relation to a similar appraisal, at the same moment, of the outlook for other companies with their individual prospects. Occasionally, something like forced liquidation will produce a moderate deviation from this figure. This happens when a large holder presses stock on the market for reasons such as liquidating an estate or paying off a loan which may not be directly related to the seller's view of the real value of the shares. However, such pressures usually cause only moderate variation from the composite appraisal of the prevailing price of the shares, since bargain hunters normally step in to take advantage of the situation, which thereby adjusts itself. The point which is of real significance is that the price is based on the current appraisal of the situation. As changes in the affairs of the company become known, these appraisals become correspondingly more or less favorable. In relation to other stocks, these particular shares then move up or down. If the factors appraised were judged correctly, the stock becomes permanently more or less valuable in relation to other stocks. The shares then stay up or down. If more of these same factors continue to develop, they in turn are recognized by the financial community. The stock then goes and stays either further up or down, as the case may be. Therefore, the price at which the stock sold 4 years ago may have little or no real relationship to the price at which it sells today. The company may have developed a host of able new executives, a series of new and highly profitable products, or any number of similar desirable attributes that make the stock intrinsically worth 4 times as much in relation to the price of other stocks as it was worth 4 years ago. The company might have fallen into the hands of an inefficient management and slipped so badly in relation to competition that the only way recovery could occur would be through the raising of much new capital. This might force such a dilution of the shares that the stock today could not possibly be worth more than a quarter of the price of 4 years ago. Against this background, it can be seen why investors so frequently pass up stocks which would have brought them huge future gains, for ones where the gain is very much smaller. By giving heavy emphasis to the stock that hasn't gone up yet, they are unconsciously subscribing to the delusion that all stocks go up about the same amount and that the one that has already risen a lot will not climb further, while the one that has not yet gone up has something to it. Nothing could be further from the truth. The fact that a stock has or has not risen in the last several years is of no significance whatsoever in determining whether it should be bought now. What does matter is whether enough improvement has taken place or is likely to take place in the future to justify importantly higher prices than those now prevailing. Similarly, many investors will give heavy weight to the per-share earnings of the past 5 years in trying to decide whether a stock should be bought. To look at the per-share earnings by themselves and give the earnings of 4 or 5 years ago any significance is like trying to get useful work from an engine which is unconnected to any device to which that engine's power is supposed to be applied. Just knowing, by itself, that 4 or 5 years ago a company's per-share earnings were either 4 times or a quarter of this year's earnings has almost no significance in indicating whether a particular stock should be bought or sold. Again, what counts is knowledge of background conditions. An understanding of what probably will happen over the next several years is of overriding importance. The investor is constantly being fed a diet of reports and so-called analyses largely centered around these price figures for the past 5 years. He should keep in mind that it is the next 5 years' earnings, not those of the past 5 years, that now matter to him. One reason he is fed such a diet of back statistics is that if this type of material is put in a report, it is not hard to be sure it is correct. If more important matters are gone into, subsequent events may make the report look quite silly. Therefore, there is a strong temptation to fill up as much space as possible with indisputable facts, whether or not the facts are significant. However, many people in the financial community place emphasis on this type of prior year's statistics for a different set of reasons. They seem to be unable to grasp how great can be the change in just a few years' time in the real value of certain types of modern corporations. Therefore they emphasize these past earnings records in a sincere belief that detailed accounting descriptions of what happened last year will give a true picture of what will happen next year. This may be true for certain classes of regulated companies such as public utilities. For the type of enterprise which I believe should interest an investor desiring the best results for his money, it can be completely false. A striking example of this centers around events with which I had the good fortune to be quite familiar. In the summer of 1956, an opportunity arose to buy a fair-sized block of shares in Texas Instruments, Inc., from its principal officers who were also its largest stockholders. Careful study of this company revealed that it rated not just well but magnificently in regard to our 15-point test. Reason for the officers to sell appeared entirely legitimate. This occurs frequently in true growth companies. Their holdings had already advanced so much that several of them had become millionaires so far as their holdings in their own company were concerned. In contrast, their other assets were relatively negligible. Therefore, particularly since they were selling but a tiny part of the shares they owned, some diversification seemed entirely in order. The ever-present possibility of estate tax liability alone would be sufficient to make such a course prudent from the standpoint of these key executives, regardless of the future of their company. At any rate, negotiations were completed to acquire these shares at a price of 14. This represented 20 times the anticipated 1956 per-share earnings of about 70 cents. To anyone who gave particular weight to past statistics, this seemed well beyond the bounds of prudence. Per-share earnings had been reported at 39 cents, 40 cents, 48 cents, and 50 cents for the prior 4 years of 1952 to 1955 respectively, hardly an exciting growth record. Even more depressing to those who subordinate the more important factors of management and current business trends to superficial statistical comparisons, the company, through a corporate acquisition, had obtained the benefits of some loss carry-forward, which had made possible subnormal income tax charges during much of this period. This made any price calculated on the basis of past statistics seem even higher. Finally, even if 1956 earnings were included in an evaluation, a superficial study of this situation might still have produced grave forebodings. True, the company was currently doing remarkably well in the promising field of transistors. But regardless of the obviously glowing future for the semiconductor industry as a whole, how long could a company of this size be expected to maintain its strong trade position against the larger and older companies, with much stronger balance sheets, which were sure to make a major competitive effort to participate in the great growth that lay ahead for transistors? When the usual SEC channels reported this officers selling, a rash of heavy trading broke out in Texas Instruments shares with relatively little change in price. Much of this selling, I suspect, was induced by various brokerage comments that appeared. Most of these furnished the past statistical record and commented on the historically high price, the competition that lay ahead, and the inside selling. One such bulletin went so far as to express complete agreement with the management of Texas Instruments. It reported the officers were selling and stated, "We agree with them and recommend the same course." The major buyer during this period, I have been told, was a large and well-informed institution. What happened in the next 12 months? Texas Instruments' geophysical and military electronic business, overlooked in the flurry of controversy, continued to grow. The semiconductor division grew even more rapidly. More important than the growth in transistor volume were the great strides taken by this able management in research, in plans for mechanization, and in building up the distribution organization in this key semiconductor field. As evidence piled up that 1956 results were not a flash in the pan but that this relatively small company would continue as one of the largest and lowest cost producers in what promises to be one of the fastest growing segments of American industry, the financial community began revising upward the price-earnings ratio it would pay for a chance to participate in this well-run enterprise. As the summer of 1957 came around and the management publicly estimated that year's per-share earnings at around $1.10, the 54% growth in earnings had produced in just 12 months an approximate 100% increase in market value. In the original edition I went on to say, I suspect that if the headquarters of the principal divisions of this company were not located in Dallas and Houston, but were situated along the northern half of the Atlantic seaboard or in the Los Angeles metropolitan area where more financial analysts and other managers of important funds could more easily learn about the company, this price-earnings ratio might have gone even higher during this period. If, as appears probable, Texas Instruments sales and earnings continue their sharp upward trend for some years to come, it will be interesting to see whether this continued growth, of itself, does not in time provide some further upward change in the price-earnings ratio. If this happens, the stock would again go up at an even faster rate than the earnings are advancing, the combination which always produces the sharpest increases in share prices. Has this optimistic forecast been confirmed? A look at the record may jolt those who still insist that it is possible to appraise an investment by a superficial analysis of past earnings and little more. Profits rose from $1.11 per share in 1957 to $1.84 in 1958 and give promise of topping $3.50 in 1959. Since the first edition of this book was completed, the company attained honors that were bound to rivet the attention of the financial community upon it. In 1958, in the face of competition from some of the generally acclaimed giants of the electronics and electrical equipment industry, International Business Machines Corporation, overwhelmingly the largest electronic calculating machine manufacturer in the world, selected Texas Instruments to be its associate for joint research effort in the application of semiconductors to this type of equipment. Again, in 1959 Texas Instruments announced a technological breakthrough whereby it was possible to use semiconductor material of approximately the same size as existing transistors, not alone for a transistor but for a complete electronic circuit. What this may bring about in the way of miniaturization almost staggers the imagination. As the company has grown, its unusually able product research and development groups have increased proportionately. Today few informed people have much doubt that the company's long series of technical and business firsts will continue in the years ahead. How has the market price of these shares responded to all this? Has the price-earnings ratio continued to advance as, 22 months ago, I indicated appeared probable? The record would appear to be in the affirmative. Per-share earnings have a little more than tripled since 1957. The stock is up over 5 times from the price of 26.5 at which it was selling when the first edition was completed. The current price, incidentally, represents a gain of better than 1,000% from the price of 14, which was mentioned in the original edition as the price at which a fair-sized block of this stock had been bought less than 3.5 years before. In spite of this steep rise, it will be interesting to see whether further gains in sales and earnings in the years ahead do not produce still more worthwhile appreciation. This brings up another line of reasoning which causes some investors to pay undue attention to these unrelated statistics on past price ranges and per-share earnings. This is the belief that whatever has happened for a number of years is bound to continue indefinitely. In other words, some investors will find a stock the per-share earnings and market price of which have risen in each of the past 5 or 10 years. They will conclude that this trend is almost certain to continue indefinitely. I will agree that this might happen. But in view of the uncertainty in timing the results of research and of the costliness of bringing out the new products that make this type of growth possible, it is quite common for even the most outstanding growth companies to have occasional 1 to 3 year dips in their rate of earnings. Such dips can produce sharp declines in their shares. Therefore, to give emphasis to this kind of past earning record, rather than to the background conditions that can control the future earning curve, may prove very costly. Does all this mean that past earnings and price ranges should be completely ignored in deciding whether to buy a stock? No. It is only when given an importance they do not deserve that they become dangerous. They are helpful as long as it is realized they are only auxiliary tools to be used for specialized purposes and not major factors in deciding the attractiveness of a common stock. Thus, for example, a study of per-share earnings for various prior years will throw considerable light on how cyclical a stock may be, that is, on how much the company's profits will be affected by the varying stages of the business cycle. More important, comparing past per-share earnings with price ranges will furnish the price-earnings ratio at which the stock sold in the past. This serves as a base from which to start measuring what the price-earnings ratio may be in the future. Here again, however, it must be kept in mind that it is the future and not the past which governs. Perhaps the shares for years have steadily sold at only 8 times earnings. Now, however, changes in management, establishment of an outstanding research department, etc., are putting the company into the class that is currently selling around 15 times earnings instead of 8. Then anyone estimating future earnings and figuring the anticipated value of the shares at only 8 instead of 15 times earnings might again be leaning too heavily on past statistics. I headed this subdivision of my comments, "Don't forget your Gilbert and Sullivan." Perhaps I should have headed it, "Don't be influenced by what doesn't matter." Statistics of former years' earnings and particularly of per-share price ranges of these former years quite frequently have nothing to do with the case. 4. Don't fail to consider time as well as price in buying a true growth stock. Let us consider an investment situation that occurs frequently. A company qualifies magnificently as to the standards set up under our 15 points. Furthermore, very important gains in earning power are going to appear about a year from now, due to factors about which the financial community is, as yet, completely unaware. Even more important, there are strong indications that these new sources of earnings are going to grow importantly for at least several years after that. Under normal circumstances, this stock would obviously be a buy. However, there is a factor that gives us pause. Success of other ventures in prior years has given this stock so much glamour in the financial world that if it were not for these new and generally unknown influences, the stock might be considered to be reasonably priced around 20 and out of all reason at its present price of 32. Assuming that 5 years from now these new influences could easily cause it to be fully worth 75, should we, right now, pay 32 or 60% or more than we believe the stock is worth? There is always the chance that these new developments might not turn out to be as good as we think. There is also the possibility that this stock might sink back to what we consider its real value of 20. Confronted with this situation, many conservative investors would watch quotations closely. If the stock got near 20, they would buy it eagerly. Otherwise, they would leave the shares alone. This happens often enough to be worthy of somewhat closer analysis. Is there anything sacred about our figure of 20? No, because it admittedly does not take into consideration an important element of future value, the factors we know and most others don't know, which we believe will in a few years justify a price of 75. What is really important here is to find a way that we can buy the stock at a price close to the low point at which it will sell from here on in. Our concern is that if we buy at 32, the stock may subsequently go somewhere around 20. This would not alone cause us a temporary loss. More significant, it would mean that if the stock subsequently went to 75, we would have for our money only about 60% of the shares that we could have gotten if we had waited and bought at 20. Assuming that in 20 years still other new ventures would have given these shares a value not of 75 but of 200, this factor of the total number of shares we could have obtained for our money would prove extremely important. Fortunately, in a situation of this sort there is another guidepost which may be relied on, even if some of my friends in the insurance and banking worlds seem to regard it as about as safe as trying to walk over water. This is to buy the shares not at a certain price, but at a certain date. From a study of other successful ventures carried through in the past by this same company, we can learn that these ventures were reflected in the stock's price at a particular point in their development. Perhaps it averaged about 1 month before these ventures reached the pilot plant stage. Assuming that our company's shares are still selling around 32, why not plan to buy these shares 5 months from today, which will be just 1 month before the pilot plant goes on stream? Of course, the shares can still go down after that. However, even if we had bought these shares at 20, there would have been no positive guarantee against a further drop. If we have a fair chance of buying at about as low a price as possible, aren't we accomplishing our objective, even if we feel that on the basis of the publicly known factors the stock should be lower? Under these circumstances, isn't it safer to decide to buy at a certain date rather than a certain price? Fundamentally, this approach does not ignore the concept of value at all. It only appears to ignore it. Except for the probability that there would be a far greater increase in value coming in the future, it would be just as illogical as some of my financial friends claim it to be to decide to buy on a specific future date rather than at a specific price. However, when the indications are strong that such an increase is coming, deciding the time you will buy rather than the price at which you will buy may bring you a stock about to have extreme further growth at or near the lowest price at which that stock will sell from that time on. After all, this is exactly what you should be trying to do when you make any stock purchase. 5. Don't follow the crowd. There is an important investment concept which is frequently difficult to understand without considerable financial experience. This is because its explanation does not lend itself easily to precise wording. It does not lend itself at all to reduction to mathematical formulae. Time and again throughout this book I have touched upon different influences that have resulted in a common stock going up or down in price. A change in net income, a change in a company's management, appearance of a new invention or a new discovery, a change in interest rates or tax laws. These are but a few random examples of conditions that will bring about a rise or fall in the quotations for a particular common stock. All these influences have one thing in common. They are real occurrences in the world about us. They are actions which have happened or are about to happen. Now we come to a very different type of price influence. This is a change which is purely psychological. Nothing has changed in the outside or economic world at all. The great majority of the financial community merely look upon the same circumstances from a different viewpoint than before. As a result of this changed way of appraising the same set of basic facts, they make a changed appraisal of the price or the price-earnings ratio they will pay for the same shares. There are fads and styles in the stock market just as there are in women's clothes. These can, for as much as several years at a time, produce distortions in the relationship of existing prices to real values almost as great as those faced by the merchant who can hardly give away a rack full of the highest quality knee-length dresses in a year when fashion decrees that they be worn to the ankle. Let me give a specific example. In 1948 I was chatting with a gentleman whom I believe to be an able investment man. He has served as president of the New York Society of Security Analysts, a position which is usually awarded only to the more able in the financial community. At any rate, I had just arrived in New York from a visit to the headquarters of the Dow Chemical Company at Midland, Michigan. I mentioned that earnings for the fiscal year just closing would be at new high levels and that I thought the stock was a real buy. He replied that he felt it was of historic and perhaps statistical interest that a company such as Dow could ever earn this much per share. He felt, however, that these earnings did not make the stock attractive, since it was obvious that the company was enjoying a temporary post-war boom that could not last. He further explained that he felt it was impossible to judge the real value of stocks of this sort until there had occurred the same type of post-war depression that within a few years followed the Civil War and World War I. His reasoning, unfortunately, completely ignored all the potential further increase in value to this stock promised by the many new and interesting products the company was then developing. That in no future year did Dow's earnings fall anywhere near as low as this supposedly abnormal peak is not what should concern us here. Neither is the fact that from this supposedly high plateau at which it was then selling, the stock has since climbed many hundreds %. Our interest should be in why this normally able investment man would take this set of facts and derive from it a quite different conclusion as to the intrinsic value of the stock than he would have derived from the same facts in some other year. The answer is that for these 3 years, from 1947 to 1949, almost the whole financial community was indulging in a mass delusion. With all the ease of hindsight we can now sit back and see that what appeared so frightening then was almost as little related to reality as the terror that gripped most of Christopher Columbus's crew in 1492. Night after night most of the common seamen on the Santa Maria were unable to sleep because of a paralyzing fear that at any moment their ship would fall off the ends of the earth and be lost forever. In 1948, the investment community gave little value to the earnings of any common stock because of the widespread conviction that nothing could prevent the near future bringing the same type of bitter depression and major stock market crash that happened about the same number of years after each of the 2 preceding major wars. In 1949, a slight depression did occur. When its modest nature was appraised and the financial community found that the subsequent trend was up, not down, a tremendous psychological change occurred in the way common stocks were regarded. Many common stocks more than doubled in price in the following few years, due to nothing more than this psychological change. Those common stocks which also had the benefit of more tangible outside occurrences improving their fundamental worth did a great deal better than just doubling. These great shifts in the way the financial community appraises the same set of facts at different times are by no means confined to stocks as a whole. Particular industries and individual companies within those industries constantly change in financial favor, due as often to altered ways of looking at the same facts as to actual background occurrences themselves. For example, In certain periods, the armament industry has been considered unattractive by the investment community. One of its most outstanding characteristics has been considered to be domination by a single customer, the government. This customer in some years goes in for heavy military procurement, and in others cuts buying way down. Therefore, the industry never knows from one year to the next when it may be subject to major contract cancellations and drying up of business. To this must be added the abnormally low profit margin that customarily prevails in government work, and the tendency of the renegotiation laws to take most of what profit is made, but never correspondingly to allow for a mistake in calculations that causes a loss. Furthermore, the constant necessity to keep bidding on new models in a field where engineering changes come continuously means that risk and turmoil are the order of the day. It is impossible, no matter how good your engineering, to standardize anything that gives your company a long-term advantage over the aggressive competition. Finally, there is always the danger that peace might break out with an accompanying decline in business. When this view prevails, as it has many times in the past 20 years, the defense shares sell at a quite low price in relation to their earnings. However, the financial community has at times in the recent past derived other conclusions from the same set of facts. The world situation is such that the need of heavy expenditures for airborne defense equipment will be with us for years. While the total value may vary from year to year, the pace of engineering change is causing more and more expensive equipment to be needed, so that the long-range trend will be upward. This means that the happy investor in these securities will be in one of the few industries which will in no sense feel the next business depression, which sooner or later will be felt by most other industries. While the profit margin is limited by law, so much business is available to the well-run company that this proves no ceiling upon total net profits. When this view prevails, a quite different appraisal is being given to exactly the same background facts. These stocks then sell on a quite different basis. Examples could be given for industry after industry which in the past 20 years has been looked upon first one way, then another, by the financial community, with a resultant change in quoted values. In 1950, pharmaceutical stocks were generally regarded as having about the same set of desirable characteristics usually credited to industrial chemical companies. Endless growth due to the wonders of research and a steady rise in the standard of living seemed to warrant the best of these shares selling at the same ratio to earnings as the best of the chemicals. Then a single manufacturer got into trouble on a heretofore glamorous item. The realization swept the financial community that this was a field in which dominance today is no assurance of being even one of the top companies tomorrow. A reappraisal of the entire industry took place. Completely different price-earnings ratios prevailed, due, in all cases but one, not to a different set of facts but a different appraisal of the same facts. In 1958, just the reverse took place. In the business slump of that year, one of the few industries that enjoyed increased rather than decreased demand for its products was the drug manufacturing industry. Profits of most companies in this group rose to new highs. At the same time, earnings of the chemical producers fell rather sharply, largely because of excess capacity from major expansion moves that had just been completed. The volatile financial community again started sharply upgrading the price-earnings ratio of drug shares. Meanwhile, sentiment started to grow that the chemical stocks were not as attractive as had previously been supposed. All this represented only changed financial appraisals. Nothing of fundamental or intrinsic consideration had happened. A year later, some of this new sentiment had already been reversed. As the better chemical companies proved among the first to recover lost earning power and as their growth trend caused profits soon to go to new all-time high levels, they rather quickly regained their temporarily lost prestige. With the long-range significance of an ever-growing number of important new drugs tending further to bolster the status of the pharmaceutical stocks as against governmental attacks on pricing and patent policies of this industry working in the opposite direction, it will be interesting to observe over the next several years whether the recently regained standing of the pharmaceutical stocks grows still further or starts to shrink. In the original edition, I went on to give one current example of this same sort of changed financial appraisal, by saying, one more example is a change in outlook that is taking place right now. For years the shares of the machine tool manufacturers have sold at a very low ratio to earnings. It was almost unanimously felt that machine tools were the epitome of a feast or famine industry. No matter how good such earnings were, they did not mean much because they were just the product of a prevailing boom and could not last. Recently, however, a new school, while by no means predominating the thinking on this subject, has been gaining converts. This school believes that since World War II a fundamental change has taken place affecting these companies. All industry has been swinging from short to long-range planning of capital expenditures. As a result, the cause of extreme fluctuation for the machine tool companies has disappeared. High and rising wage rates will prevent for many years, if not forever, a return to the feast or famine nature of this business. The steady pace of engineering advance has increased and will further increase the pace of obsolescence of this industry's products. Therefore, in place of the largely cyclical pre-war trends, the growth trend of the recent past will continue further into the future. Automation may cause this growth trend to be spectacular. Under the influence of those who think this way, the better machine tool stocks are now appraised on a somewhat more favorable basis in relation to the market as a whole than they were only a few years ago. They still sell at a rather low ratio to earnings because the influence of the feast or famine idea is still strong, even if it is not as strong as it used to be. If the financial community comes more and more to accept this non-cyclical and growth outlook for machine tool stocks, their price-earnings ratio will improve more and more. They will then do much better than the market. If the old feast or famine concept regains its former hold, these shares will sell at a lower ratio to earnings than prevails today. This current machine tool example brings into clear relief what the common stock investor must do if he is to purchase shares to his greatest advantage. He must examine factually and analytically the prevailing financial sentiment about both the industry and the specific company of which he is considering buying shares. If he can find an industry or a company where the prevailing style or mode of financial thinking is considerably less favorable than the actual facts warrant, he may reap himself an extra harvest by not following the crowd. He should be extra careful when buying into companies and industries that are the current darlings of the financial community, to be sure that these purchases are actually warranted, as at times they well may be, and that he is not paying a fancy price for something which, because of too favorable interpretation of basic facts, is the investment fad of the moment. Today, of course, we know the answer to the recent ideas of some that the machine tool industry is no longer feast or famine in its nature. The 1957 recession completely exploded the idea that long-range corporate planning now cushions these stocks from their normal extreme vulnerability to downward movements in the business cycle. However, for every problem of this sort which gets solved, the ever-increasing pace of today's technology opens up a dozen others from which the wise investor can profit if he can think independently of the crowd and reach the right answer when the majority of financial opinion is leaning the other way. Are the exotic fuel stocks and certain of the smaller electronics intrinsically worth the high appraisals being given them today? Is there such a future for manufacturers of ultrasonic equipment that ordinary price earnings may be disregarded? Is a company better or worse for the American investor if an abnormally large part of its earning power is derived from foreign operations? These are all matters about which the ideas of the multitude may have swung too far or not far enough right now. If he is thinking of participating in the affected companies, the wise investor must determine which are fundamental trends that will go further, and which are fads of the moment. These investment fads and misinterpretations of facts may run for several months or several years. In the long run, however, realities not only terminate them, but frequently, for a time, cause the affected stocks to go too far in the opposite direction. The ability to see through some majority opinions to find what facts are really there is a trait that can bring rich rewards in the field of common stocks. It is not easy to develop, however, for the composite opinion of those with whom we associate is a powerful influence upon the minds of us all. There is one factor which all of us can recognize, however, and which can help powerfully in not just following the crowd. This is realization that the financial community is usually slow to recognize a fundamentally changed condition, unless a big name or a colorful single event is publicly associated with that change. The ABC company's shares have been selling at a very low price, in spite of the attractiveness of its industry, because it has been badly managed. If a widely known man is put in as the new president, the shares will usually not only respond at once, but will probably over-respond. This is because the time it takes to bring about basic improvement will probably be overlooked in the first enthusiasm. However, if the change to a superb management comes from the brilliance of heretofore little-known executives, months or years may go by during which the company will still have poor financial repute and sell at a low ratio to earnings. Recognizing such situations prior to the price spurt that will inevitably accompany the financial community's correction of its appraisal is one of the first and simplest ways in which the fledgling investor can practice thinking for himself rather than following the crowd. 10. How I go about finding a growth stock. After the publication of the original edition of Common Stocks and Uncommon Profits, I began receiving an amazing, to me, number of letters from readers all over the country. One of the most common requests made was for more detailed data about just what an investor should do to find investments that will lead to spectacular gains in market price. Since there is so much interest in this matter, it may be beneficial to include some comments on this subject here. Doing these things takes a great deal of time, as well as skill and alertness. The small investor may feel a disproportionate amount of work is involved for the sums he has at his disposal. It would be nice, not only for him but also for the large investor, if there were some easy, quick way of selecting bonanza stocks. I strongly doubt that such a way exists. How much time should be spent on these matters is, of course, something each investor must decide for himself in relation to the sums he has available for investment, his interests, and his capabilities. I cannot say with any assurance that my method is the only possible system for finding bonanza investments. Nor can I even be completely sure that it is the best method, although, obviously, if I thought some other available approach were better, I would not be using this one. For some years, however, I have followed the steps I am about to outline in detail. Doing this has worked and worked well for me. Particularly in the highly important earlier stages, someone else with greater background knowledge, better contacts, or more ability might make some important variations in these methods and attain further improvement in overall results. There are 2 stages in the following outline, at each of which the quality of the decisions made will have tremendous effect upon the financial results obtained. Everyone will recognize instantly the overwhelming importance of the decision at the second of these 2 critical points, which is, do I now buy this particular stock or do I not? What may not be as easy to recognize is that right at the start of an organized method for selecting common stocks, decisions must also be made that can have just about as great an impact on the chance of uncovering an investment that 10 years later will have increased, say, 12-fold in value rather than that has not quite doubled. This is the problem that confronts anyone about to start on a quest for a major growth security. There are literally thousands of stocks in dozens of industries that could conceivably qualify as worthy of the most intensive study. You cannot be sure about many of them until considerable work has been done. However, no one could possibly have the time to investigate more than a tiny percent of the available field. How do you select the one or the very few stocks to the investigation of which you will devote such time as you have to spare? This is a far more complex problem than it seems. You must make decisions that can easily screen out from investigation situations that a few years later have produced fortunes. You may make decisions that limit your work to rather barren soil, in that as you gather more data the outlook appears more and more clear that you are approaching the answer you are bound to find in the overwhelming majority of all investigations. This is that the company is run-of-the-mill or maybe a little better, but that it just is not the occasional bonanza that leads to spectacular profit. Yet this key decision determines whether, financially speaking, you are prospecting rich or poor on the basis of relatively little knowledge of the facts. This is because you must make decisions on what to or what not to spend your time before you have done enough work to have a proper basis for your conclusion. If you have done enough work to have adequate background for your decisions, you will have already spent so much time on each situation that, in effect, you will have made this vital first decision on a snap basis anyway. You just will not have realized that you have done so. Some years ago I would sincerely but mistakenly have told you that I used what would have sounded like a neat method for solving this problem. As a result of companies which I had already investigated, and particularly as a result of familiarity with the companies in which the funds I manage were concentrated, I had become friendly with a sizable number of quite able business executives and scientists. I could talk to these people about companies other than their own. I believed that ideas and leads furnished by such unusually well-informed contacts would provide a magnificent supply of prospects for investigation that would contain an abnormally large percent of companies that might prove to have the outstanding characteristics I am constantly seeking. However, I attempt to use the same analytical and self-critical methods of improving the techniques of my own business that I expect the companies in which I invest to use to improve their operations. Therefore, some years ago I made a study to determine two things. How had I come to select the companies which I had chosen for investigation? With hindsight to help me, were there significant variations in the percentage of worthwhile results between investigations made as a result of the original spark plug idea coming from one type of source and those coming from sources of a completely different nature? What I found astonished me but is entirely logical on analysis. The business executive scientist classification, which I had believed was my main source of original ideas causing me to investigate one company rather than another, actually had furnished only about 1/5 of the leads that had excited me enough to engage in a further study. Of even greater significance, these leads had not proven an above-average source of good investments. This 1/5 of total investigations had led to only about 1/6 of all worthwhile purchases. In contrast, the first original idea for almost 4/5 of the investigations and almost 5/6 of the ultimate payout had come from a quite different group. Across the nation I had gradually come to know and respect a small number of men whom I had seen do outstanding work of their own in selecting common stocks for growth. A not necessarily complete list of these able investment men would include one or more living in such widely scattered places as New York, Boston, Philadelphia, Buffalo, Chicago, San Francisco, Los Angeles, and San Diego. In many instances I might not agree at all with the conclusions of any of these men as to a stock they particularly liked, even to the point of feeling it worthy of investigation. In one or two cases, I might even consider the thoroughness of their work as suspect. However, because in each case I knew their financial minds were keen and their records impressive, I would be disposed to listen eagerly to details they might furnish concerning any company within my range of interests that they considered unusually attractive for major appreciation. Furthermore, since they were trained investment men, I could usually get rather quickly their opinion upon the key matters most important to me in my decision as to whether it might be a good gamble to investigate the company in question. What are these key matters? Essentially they cover how the company would measure up to our already discussed 15 points, with special emphasis in this preliminary stage on two specific subjects. Is the company in, or being steered toward, lines of business affording opportunities of unusual growth in sales? Are these lines where, as the industry grows, it would be relatively simple for newcomers to start up and displace the leading units? If the nature of the business is such that there is little way of preventing newcomers from entering the field, the investment value of such growth as occurs may prove rather slight. How about using investment men of fewer accomplishments or less ability as a source of original leads on what to investigate? If I did not feel that better men were available, I doubtless would use them somewhat more than I do. I always try to find the time at least to listen once to any investment man, if only to be on the alert for keen younger men coming up in the business and to be sure I am not overlooking one. However, the competition for time is terrific. As I downgrade either a financial man's investment judgment or his reliability as to facts presented, I find my tendency to spend time investigating the company he presents decreasing even more than proportionally. How about selecting original leads for investigation from the ideas in printed material? Occasionally I have been influenced by the special reports issued by the most reliable brokerage houses when these reports are not for widespread distribution but solely to a few selected people. However, on the whole, I would feel the typical public printed brokerage bulletin available to everyone is not a fertile source. There is too much danger of inaccuracies in them. More important, most only repeat what is already common knowledge in the financial community. Similarly, I will occasionally get a worthwhile idea from the best of the trade and financial periodicals, but because I believe they have certain inherent limitations on what they can print about many of the matters of greatest interest to me, I do not find them a rich source of new ideas on the best companies to investigate. There is another possible source of worthwhile original leads which others with better technical backgrounds or greater ability might be able to employ profitably, although I have not successfully done so. This source is the major consulting research laboratories such as Arthur D. Little, Stanford Research Institute, or Battelle. I have found that personnel of these organizations have great understanding of just the business and technical developments from which worthwhile original investment ideas should come. However, I have found the usefulness of this group largely blocked by their tendency to be unwilling to discuss most of what they know because it might violate the confidence of the client companies for which they have worked. If someone smarter than I am could find a way, without injury to these client companies, of unlocking the mine of investment information I suspect these organizations possess, he might well have found a means of importantly improving on my methods regarding this particular step in the quest for growth stocks. So much for step 1. On the basis of a few hours' conversation, usually with an outstanding investment man, occasionally with a business executive or scientist, I have made a decision that a particular company might be exciting. I will start my investigation. What do I do next? There are 3 things I emphatically do not do. I do not approach anyone in the management at this stage. I do not spend hours and hours going over old annual reports and making minute studies of minor year-by-year changes in the balance sheet. I do not ask every stockbroker I know what he thinks of the stock. I will, however, glance over the balance sheet to determine the general nature of the capitalization and financial position. If there is an SEC prospectus, I will read with care those parts covering breakdown of total sales by product lines, competition, degree of officer or other major ownership of common stock, and all earning statement figures throwing light on depreciation, profit margins, extent of research activity, and abnormal or non-recurring costs in prior years' operations. Now I am ready really to go to work. I will use the scuttlebutt method I have already described just as much as I possibly can. Here, rather than as a source of original ideas for investment, is where the people I have come to know in the business executive scientist group can be of inestimable value. I will try to see every key customer, supplier, competitor, ex-employee, or scientist in a related field that I know or whom I can approach through mutual friends. However, suppose I still do not know enough people or do not have a friend of a friend who knows enough of the people who can supply me with the required background. What do I do then? Frankly, if I am not even close to getting much of the information I need, I will give up the investigation and go on to something else. To make big money on investments, it is unnecessary to get some answer to every investment that might be considered. What is necessary is to get the right answer a large proportion of the very small number of times actual purchases are made. For this reason, if way too little background is forthcoming and the prospects for a great deal more are bleak, I believe the intelligent thing to do is to put the matter aside and go on to something else. However, suppose quite a bit of background has become available. You have called on everyone you know or can readily approach, but have spotted 1 or 2 people who you believe could do much to complete your picture if they would talk freely to you. I would not just walk in on them off the street. Most people, interested as they may be in the industry in which they are engaged, are not inclined to tell to total strangers what they really think about the strong and weak points of a customer, a competitor, or a supplier. I would find out the commercial bank of the people I want to meet. If in matters of this sort you approach a commercial bank that knows you, tell them frankly whom you want to meet and exactly why. It is surprising how obliging most commercial bankers will be in trying to help you provided you do not bother them too often. It is possibly even more surprising how helpful most businessmen will try to be if you are introduced to them by their regular bankers. Of course, this help will only be forthcoming if the bankers in question have no doubt whatsoever that the information you are seeking is solely for background purposes in determining whether to make an investment, and that under no circumstance would you ever embarrass anyone by quoting the source of any derogatory information. If you follow these rules, banking help can, at times, help complete the stage of an investigation that otherwise might never be complete enough to be of any value. It is only after Scuttlebutt has obtained for you a large part of the data that in our chapter on the 15 points I indicated can best be obtained from such sources, that you should be ready to take the next step and think about approaching the management. I think it rather important that investors thoroughly understand why this is so. Good managements, those most suitable for outstanding investment, are nearly all quite frank in answering questions about the company's weak points as fully as about its strong points. However, no matter how punctilious a management may be in this respect, no corporate officer in his own self-interest can be expected, unasked, to volunteer some of the most significant matters for you, the investor, to know. How can a vice president to whom you say, "Is there anything else you think I, as a prospective investor, should know about your company," give a reply to the effect that the other top members of the management team are doing splendidly but several years of poor work by the vice president for marketing is beginning to cause weakness in sales? Could he possibly volunteer further that this may not be too important, since young Williams, on the marketing staff, has outstanding ability and in another 6 months he will be in charge and the situation brought back under control? Of course he could not volunteer these things. However, I have found that if he learns you already know of the marketing weakness, his remark may be diplomatically worded, but with the right type of management and if they have confidence in your judgment, you will be furnished with a realistic answer as to whether anything is or is not being done to remedy weaknesses of this type. In other words, only by having what Scuttlebutt can give you before you approach management, can you know what you should attempt to learn when you visit a company. Without it you may be unable to determine that most basic of points the competency of top management itself. In even a medium-sized company, there may be a key management team of as many as 5 men. You are not apt to meet all of them on your first or second visit. If you do, you will probably meet some for such a short time you will have no basis for determining their relative ability. Frequently 1 or 2 men of the 5 will be far more able or far less able than the others. Without Scuttlebutt to guide you, depending on whom you meet you may form far too high or far too low an estimate of the entire management. With Scuttlebutt you may have formed a fairly accurate idea of who is particularly strong or particularly weak, and are in a better position to ask to meet the specific officers you may want to know better, thereby satisfying yourself as to whether this Scuttlebutt impression is correct. It is my opinion that in almost any field nothing is worth doing unless it is worth doing right. When it comes to selecting growth stocks, the rewards for proper action are so huge and the penalty for poor judgment is so great that it is hard to see why anyone would want to select a growth stock on the basis of superficial knowledge. If an investor or financial man wants to go about finding a growth stock properly, I believe one rule he should always follow is this: he should never visit the management of any company he is considering for investment until he has first gathered together at least 50% of all the knowledge he would need to make the investment. If he contacts the management without having done this first, he is in the highly dangerous position of knowing so little of what he should seek that his chance of coming up with the right answer is largely a matter of luck. There is another reason I believe it so important to get at least half the required knowledge about a company before visiting it. Prominent management and managements in companies in colorful industries get a tremendous number of requests for their time from people in the investment business. Because the price at which their stock sells can have so much significance to them in so many ways, they will usually devote the time of valuable people to such visitors. However, from company after company I have heard the same type of comment. To no one will they be rude, but the amount of time furnished by key men, rather than by those who receive financial visitors but make few executive decisions, depends far more on the company's estimate of the competence of the visitor than it does on the size of the financial interest he represents. More important, the degree of willingness to furnish information, that is, how far the company will go in answering specific questions and discussing vital matters, depends overwhelmingly on this estimate of each visitor. Those who just drop in on a company without real advance preparation often have two strikes against them almost before the visit starts. This matter of whom you see is so important that it is wise to go to considerable trouble to be introduced to management by the right people. An important customer or a major stockholding interest known to management can be an excellent source of introduction to pave the way for a first visit. So can the company's investment banking connections. In any event, those really wanting to get optimum results from their first visit should make sure that those introducing them have a high regard for the visitor and pass the reasons for this good opinion on to the management. Just a few weeks prior to my writing these words, an incident occurred which may illustrate how much preparation I feel should be made prior to a first call on management. I was lunching with two representatives of a major investment firm, one which is the investment banker for two of the handful of companies in which the funds I manage are invested. Knowing the small number of situations I go into and the long time I normally hold them, one of these gentlemen asked me the ratio between the new companies I visited and the ones of these into which I actually bought. I asked him to guess. He estimated I bought into one for every 250 visited. The other gentleman ventured that it might be one for every 25. Actually, it runs somewhere between 1 to every 2 and 1 to every 2.5. This is not because 1 out of every 2.5 companies I look at measures up to what I believe are my rather rigorous standards for purchase. If he had substituted companies looked at for companies visited, perhaps 1 in 40 or 50 might be about right. If he had substituted companies considered as possibilities for investigation, then the original estimate of one stock bought for every 250 considered would be rather close to the mark. What he had overlooked was that I believe it so impossible to get much benefit from a plant visit until a great deal of pertinent scuttlebutt work has been done first, and that I have found that scuttlebutt so many times furnishes an accurate forecast of how well a company will measure up to my 15 points, that usually by the time I am ready to visit the management there will be at least a fair chance that I will want to buy into the company. A great many of the less attractive situations will have been weeded out along the way. This about sums up how I go about finding growth stocks. Possibly 1/5 of my first investigations start from ideas gleaned from friends in industry and 4/5 from culling what I believe are the more attractive selections of a small number of able investment men. These decisions are frankly a fast snap judgment on which companies I should spend my time investigating and which I should ignore. Then after a brief scrutiny of a few key points in an SEC prospectus, I will seek scuttlebutt aggressively, constantly working toward how close to our 15-point standard the company comes. I will discard one prospective investment after another along the way. Some because the evidence piles up that they are just run-of-the-mill. Others because I cannot get enough evidence to be reasonably sure one way or the other. Only in the occasional case when I have a great amount of favorable data do I then go to the final step of contacting the management. Then if after meeting with management I find my prior hopes pretty well confirmed and some of my previous fears eased by answers that to me make sense, at last I am ready to feel I may be rewarded for all my efforts. Because I have heard them so many times, I know the objections a few of you will make to this approach. How can anyone be expected to spend this amount of time finding just one investment? Why are not the answers already neatly worked out for me by the first person in the investment business to whom I ask what I should buy? I would ask those with this reaction to look at the world around them. In what other line of activity could you put $10,000 in 1 year and 10 years later be able to have an asset worth from $40,000 to $150,000? This is the kind of reward gained from selecting growth stocks successfully. Is it either logical or reasonable that anyone could do this with an effort no harder than reading a few simply worded brokers' free circulars in the comfort of an armchair one evening a week? Does it make sense that anyone should be able to pick up this type of profit by paying the first investment man he sees a commission of $135, which is the New York Stock Exchange charge for buying 500 shares of stock at $20 per share? So far as I know, no other fields of endeavor offer these huge rewards this easily. Similarly, they cannot be made in the stock market unless you or your investment advisor utilize the same traits that will bring large rewards in any other field of activity. These are great effort combined with ability and enriched by both judgment and vision. If these attributes are employed and something fairly close to the rules laid down in this chapter are used to find companies measuring well on our 15-point standard but not yet enjoying as much status in the financial community as such an appraisal would warrant, the record is crystal clear that fortune-producing growth stocks can be found. However, they cannot be found without hard work and they cannot be found every day. 11. Summary and conclusion. We are starting the second decade of a half-century that may well see the standard of living of the human race advance more than it has in the preceding 5,000 years. Great have been the investment risks of the recent past. Even greater have been the financial rewards for the successful. However, in this field of investment, the risks and rewards of the past 100 years may be small beside those of the next 50. In these circumstances it may be well to take stock of our situation. We almost certainly have not conquered the business cycle. We may not even have tamed it. Nevertheless, we have added certain new factors that significantly affect the art of investment in common stocks. One of these is the emergence of modern corporate management, with all that this has done to strengthen the investment characteristics of common shares. Another is the economic harnessing of scientific research and developmental engineering. The emergence of these factors has not changed the basic principles of successful common stock investment. It has made them more important than ever. This book has attempted to show what these basic principles are, what type of stock to buy, when to buy it, and most particularly, never to sell it as long as the company behind the common stock maintains the characteristics of an unusually successful enterprise. It is hoped that those sections dealing with the most common mistakes of many otherwise able investors will prove of some interest. It should be remembered, however, that knowing the rules and understanding these common mistakes will do nothing to help those who do not have some degree of patience and self-discipline. One of the ablest investment men I have ever known told me many years ago that in the stock market a good nervous system is even more important than a good head. Perhaps Shakespeare unintentionally summarized the process of successful common stock investment. There is a tide in the affairs of men which, taken at the flood, leads on to fortune. Part 2. Conservative investors sleep well. All of my business life, I have believed that the success of my own business or any business depends on following the principles of 2 I's and an H. These principles are integrity, ingenuity, and hard work. I would like to dedicate this book to my 3 sons in the belief that Arthur and Ken are following the principles of the 2 I's and an H in businesses very similar to mine, as is Don in one that is quite different. Introduction. While these things are hard to measure precisely, indications are overwhelming that only once before in this century has the morale of the American investor been at anything like the low ebb that exists as these words are being written. The well-known and much publicized Dow Jones Industrial Average is an excellent indicator of the day-to-day change in stock market levels. However, when a longer period is under consideration, this average may mask rather than reveal the full extent of the injuries suffered by many who have held common stocks in the recent past. One index that purports to show what has happened to all publicly traded common stocks but that does not weigh each stock issue by the number of shares outstanding shows the average stock in mid-1974 down 70% from its 1968 peak. Faced with this kind of loss, large groups of investors have acted in completely predictable ways. One group has pulled out of stocks completely. Yet many corporations are doing surprisingly well. In an environment where more and more inflation appears inevitable, properly selected stocks may be far less risky than some other placements that appear safer. There is an even larger group that is of particular interest, people who have decided that, from now on we will act more conservatively. The usual rationale here is to confine purchases only to the largest companies, the names of which at least are known to almost everyone. There are probably few investors in the United States and almost none in the Northeast who do not know the names Penn Central and Consolidated Edison or the nature of these companies' services. By conventional standards, Penn Central some years ago and Consolidated Edison more recently were considered conservative investments. Unfortunately, Often there is so much confusion between acting conservatively and acting conventionally that for those truly determined to conserve their assets, this whole subject needs considerable untangling, which should start with not one definition but two. 1. A conservative investment is one most likely to conserve purchasing power at a minimum of risk. 2. Conservative investing is understanding of what a conservative investment consists, and then, in regard to specific investments, following a procedural course of action needed properly to determine whether specific investment vehicles are, in fact, conservative investments. Consequently, to be a conservative investor, not one but two things are required either of the investor or of those whose recommendations he is following. The qualities desired in a conservative investment must be understood. Then a course of inquiry must be made to see if a particular investment so qualifies. Without both conditions being present, the buyer of common stocks may be fortunate or unfortunate, conventional in his approach or unconventional, but he is not being conservative. It seems to me of overriding importance that confusion on matters such as these be swept aside for all time to come. Not only stockholders themselves but also the American economy as a whole cannot afford ever again to have those who make a sincere effort to understand the rules suffer the type of bloodbath recently experienced by this generation of investors, a bloodletting exceeded only by that which another generation experienced in the Great Depression some 40 years earlier. America today has unparalleled opportunities for improving the way of life for all its people. It certainly has the technical knowledge and the know-how to do so. However, to do these things in the traditional American way will require some genuine re-education as to the basic fundamentals for a great many investors as well as for many of those in the investment industry itself. Only if many more investors come to feel financially secure because they truly are secure will there be a reopening of the markets for new stock issues that will enable companies legitimately requiring additional equity funds to be in a position to secure them on a basis conducive to going ahead with new projects. If this does not happen, all that is left is to try to go ahead with what needs to be done in the way that, both here and abroad, has always proven so costly, wasteful, and inefficient by government financing, with management under the dead hand of bureaucratic officialdom. For these reasons I believe that the investors' problems of today should be met head-on and forthrightly. In an attempt to deal with these problems in this book, I have leaned heavily on the counsel of my son, Ken, who contributed the title as well as many other matters, including part of the basic conception of what lies herein. I cannot adequately acknowledge his assistance in this presentation. This book is divided into 4 distinct sections. The first deals with the anatomy, if the word may be used, of a conservative stock investment as delineated in definition number 1. The second analyzes the part played by the financial community, the mistakes, if you will, that helped produce the current bear market. This critique was not intended merely to throw rocks but to point out that similar errors can be avoided in the future and that certain basic investment principles become clear when the mistakes of the recent past are studied. The third section deals with the course of action that must be taken to qualify as conservative investing as delineated in definition number 2. The final section deals with some of the influences rampant in today's world that have caused grave doubts in the minds of many as to whether any common stock is a suitable means for preserving assets. In other words, whether for anything other than as gambling vehicles common stocks should be considered at all. This book will, I hope, throw light on whether the problems that helped produce the recent bear market have created a condition where stock ownership is just a trap for the unwary, or whether, as in every prior major bear market in U.S. history, they have created a magnificent opportunity for those with the ability and the self-discipline to think for themselves and to act independently of the popular emotions of the moment. PAF San Mateo, California. The first dimension of a conservative investment. Superiority in production, marketing, research, and financial skills. A corporation of the size and type to provide a conservative investment is necessarily a complex organization. To understand what must be present in such an investment, we might start by portraying one dimension of the characteristics we must be sure exist. This dimension breaks down into 4 major subdivisions. Low-cost production. To be a truly conservative investment, a company for a majority if not for all of its product lines must be the lowest cost producer or about as low a cost producer as any competitor. It must also give promise of continuing to be so in the future. Only in this way will it give its owners a broad enough margin between costs and selling price to create two vital conditions. One is sufficient leeway below the break-even point of most competition. When a bad year hits the industry, prices are unlikely to stay for long under this break-even point. As long as they do, losses for much of the higher cost competition will be so great that some of these competitors will be forced to cease production. This almost automatically increases the profits of the surviving low-cost companies because they benefit from the increased production that comes to them as they take over demand formerly supplied by the closed plants. The low-cost company will benefit even more when the decreased supply from competitors enables it not only to do more business but also to increase prices as excess supplies stop pressing on the market. The second condition is that the greater than average profit margin should enable a company to earn enough to generate internally a significant part or perhaps all of the funds required for financing growth. This avoids much or even all of the need for raising additional long-term capital that can result in new shares being issued and diluting the value of already outstanding shares or create an additional burden of debt, with fixed interest payments and fixed maturities which greatly increase the risks of the common stock owners. However, it should be realized that, just as the degree to which a company is a low-cost producer increases the safety and conservatism of the investment, so in a boom period in a bullish market does it decrease its speculative appeal. The percentage that profits rise in such times will always be far greater for the high-cost, risky, marginal company. Simple arithmetic will explain why. Let us take an imaginary example of two companies of the same size that, when times were normal, were selling widgets at 10 cents apiece. Company A has a profit of 4 cents per widget and Company B of 1 cent. Now let us suppose that costs remain the same but a temporary extra demand for widgets pushes up the price to 12 cents, with both companies remaining the same size. The strong company has increased profits from 4 cents per widget to 6 cents, a gain of 50%, but the high-cost company has made a 300% profit gain, or tripled its profits. This is why, short range, the high-cost company sometimes goes up more in a boom and also why, a few years later, when hard times come and widgets fall back to 8 cents, the strong company is still making a reduced but comfortable profit. If the high-cost company doesn't go bankrupt, it is likely to produce another crop of badly hurt investors, or perhaps speculators who thought they were investors, who are sure something is wrong with the system rather than with themselves. All of the above has been written with manufacturing companies in mind, hence the term production has been used. Many companies, of course, are not manufacturers but are in service lines, such as wholesaling, retailing, or one of the many subdivisions of the financial world such as banking or insurance. The same principles apply, but the word operations is substituted for production and a low or high-cost operator for a low or high-cost producer. Strong marketing organization. A strong marketer must be constantly alert to the changing desires of its customers so that the company is supplying what is desired today, not what used to be desired. At the turn of the century, for example, there was something wrong with the marketing efforts of a leading manufacturer of horse-drawn buggies if it persisted in trying to compete by making finer and finer buggies rather than turning to automobiles or going out of business altogether. To bring our example up to date, perhaps well before the Arab oil embargo made every home in America aware that large automobiles were big gas guzzlers, there was something wrong with the segment of the automobile industry that failed to recognize the ever-increasing popularity of small imported compacts as a sign that public demand was swinging toward a product that cost less, was cheaper to operate, and was easier to park than the larger, flashier models that for so many years had been favorites. But recognizing changes in public taste and then reacting promptly to these changes is not enough. As has been said before, in the business world customers simply do not beat a path to the door of the man with the better mousetrap. In the competitive world of commerce it is vital to make the potential customer aware of the advantages of a product or service. This awareness can be created only by understanding what the potential buyer really wants and explaining it to him not in the seller's terms but in his terms. Whether this is best done by advertising, by salesmen making calls, by specialized independent marketing organizations, or by any combination of these depends on the nature of the business. But what is Required in every instance is close control and constant managerial measurement of the cost-effectiveness of whatever means are used. Lack of outstanding management in these areas can result in losing a significant volume of business that would otherwise be available, in having much higher costs and therefore obtaining smaller profit on what business is obtained, and because of companies having variations in the profitability of various elements of their product line, in failing to attain the maximum possible profit mix within the line. An efficient producer or operator with weak marketing and selling may be compared to a powerful engine that, because of a loose pulley belt or badly adjusted differential, is producing only a fraction of the results it otherwise would have attained. Outstanding research and technical effort. Not so very long ago it seemed that outstanding technical ability was vital only to a few highly scientifically oriented industries such as electronics, aerospace, pharmaceutical, and chemical manufacturing. As these have grown, their ever-widening technologies have so penetrated virtually all lines of manufacturing and nearly all the service industries that today to have outstanding research and technical talent is nearly, if not quite, as important for a shoe manufacturer, a bank, a retailer, or an insurance company as it is for what were once considered the exotic scientific industries that maintained large research staffs. Technological efforts are now channeled in two directions: to produce new and better products and to perform services in a better way or at a lower cost than in the past. With regard to the latter objective, outstanding technical talent can be equally valuable for either group. Actually, in some of the service businesses, technological groups are opening up new product lines as well as paving the way for performing old services better. Banks are an example. Low-cost electronic input devices and mini-computers are enabling them to offer accounting and bookkeeping services to customers, thus creating a new product line for these institutions. In research and technology, there is as much variation between the efficiency of one company and another as there is in marketing. In new product development, the complexity of the task almost guarantees this. Important as it is, the degree of technical competence or ingenuity of one company's research staff as compared to that of another is only one of the factors affecting the benefits that the company derives from its research efforts. Developing new products usually calls for the pooling of the efforts of a number of researchers, each skilled in a different technological specialty. How well these individuals work together is often as important as the individual competence of the people involved. Furthermore, to maximize profits, it is vital not to develop just any product but one for which there will be significant customer demand, one that can be sold by the company's existing marketing organization, and one that can be made at a price that will yield a worthwhile profit. All of this requires efficient liaison between research and both marketing and production. The best corporate research team in the world can become nothing but a liability if it develops only products that cannot be readily sold. For true investment superiority, a company must have above-average ability to control all these complex relationships yet at the same time not so over-control them as to cause its researchers to lose the drive and the ingenuity that made them outstanding in the first place. Financial skill. Again and again in this discussion of production, marketing, and research, the terms profit and profit margin have been used. In a large company with a diverse product line, it is not a simple matter to be sure of the cost of each product in relation to the rest, as most costs other than materials and direct labor are spread over a number of such products, maybe over all of them. Companies with above-average financial talent have several significant advantages. Knowing accurately how much they make on each product, they can make their greatest efforts where these will produce maximum gains. Intimate knowledge of the extent of each element of costs, not just in manufacturing but in selling and research as well, spotlights in even minor phases of company activity the places where it is logical to make special efforts to reduce costs, either through technological innovations or by improving people's specific assignments. Most important of all, through skillful budgeting and accounting. The truly outstanding company can create an early warning system whereby unfavorable influences that threaten the profit plan can be quickly detected. Remedial action can then be taken to avoid the painful surprises that have jolted investors in many companies. Nor do the goodies that accrue to investors from superior financial skills stop at this point. They usually lead to a better choice of capital investments that bring the highest return on the company's investment capital. They also can lead to better control of receivables and inventory, a matter of increasing importance in periods of high interest rates. To summarize, the company that qualifies well in this first dimension of a conservative investment is a very low-cost producer or operator in its field, has outstanding marketing and financial ability, and a demonstrated above-average skill on the complex managerial problem of attaining worthwhile results from its research or technological organization. In a world where change is occurring at an ever-increasing pace, it is a company capable of developing a flow of new and profitable products or product lines that will more than balance older lines that may become obsolete by the technological innovations of others, a company able now and in the future to make these lines at costs sufficiently low so as to generate a profit stream that will grow at least as fast as sales, and that even in the worst years of general business will not diminish to a point that threatens the safety of an investment in the business, and a company able to sell its newer products and those which it may develop in the future at least as profitably as those with which it is involved today. This is a one-dimensional picture of a prudent investment, one which, if not spoiled by the view from other dimensions, represents an investment with which the investor is unlikely to become disillusioned. But before going on to examine these other dimensions, there is one additional point that should be fully understood. If the objective is conserving one's funds, if the goal is safety, why have we been talking about growth and the development of new and additional product lines? Why isn't it enough to maintain a business at its existing size and level of profits without running all the risks that occur when new endeavors are started? When we come to a discussion of the influence of inflation on investments, other reasons for the importance of growth will present themselves. But fundamentally, it should never be forgotten that, in a world where change is occurring at a faster and faster pace, nothing long remains the same. It is impossible to stand still. A company will either grow or shrink. A strong offense is the best defense. Only by growing better can a company be sure of not growing worse. Companies that have failed to go uphill have invariably gone downhill, and, if that has been true in the past, it will be even more true in the future. This is because, in addition to an ever-increasing pace of technological innovation, changing social customs and buying habits and new demands of government are altering at an ever-increasing pace the rate at which even the stodgiest industries are changing. 2. The second dimension. The people factor. Briefly summarized, the first dimension of a conservative investment consists of outstanding managerial competence in the basic areas of production, marketing, research, and financial controls. This first dimension describes a business as it is today, being essentially a matter of results. The second dimension deals with what produced these results and, more importantly, will continue to produce them in the future. The force that causes such things to happen, that creates one company in an industry that is an outstanding investment vehicle and another that is average, mediocre, or worse, is essentially people. Edward H. Heller, a pioneer venture capitalist whose comments during his business life greatly influenced some of the ideas expressed in this book, used the term vivid spirit to describe the type of individual to whom he was ready to give significant financial backing. He said that behind every unusually successful corporation was this kind of determined entrepreneurial personality with the drive, the original ideas, and the skill to make such a company a truly worthwhile investment. Within the area of very small companies that grew into considerably larger and quite prosperous ones, Ed Heller was undoubtedly right. But as these smaller companies grow larger on the way to becoming suitable for conservative investment, Ed Heller's view might be tempered by that of another brilliant businessman who expressed serious doubts about the wisdom of investing in a company whose president was his close personal friend. This man's reason for lack of enthusiasm: "My friend is one of the most brilliant men I've ever known. He always has to be right. In a small company this may be fine. But as you grow, your men have to be right sometimes, too." Here is an indication of the heart of the second dimension of a truly conservative investment: a corporate chief executive dedicated to long-range growth who has surrounded himself with and delegated considerable authority to an extremely competent team in charge of the various divisions and functions of the company. These people must be engaged not in an endless internal struggle for power, but instead should be working together toward clearly outlined corporate goals. One of these goals, which is absolutely essential if an investment is to be a truly successful one, is that top management take the time to identify and train qualified and motivated juniors to succeed senior management whenever a replacement is necessary. In turn, at each level down through the chain of command, detailed attention should be paid to whether those at this level are doing the same thing for those one level below them. Does this mean that a company that qualifies for truly conservative investing should promote only from within and should never recruit from the outside except at the lowest levels or for those just starting their careers? A company growing at a very rapid rate may have such need for additional people that there just isn't time to train from within for all positions. Furthermore, even the best-run company will at times need an individual with a highly specialized skill so far removed from the general activities of the company that such a specialty simply cannot be found internally. Someone with expertise in a particular subdivision of the law, insurance, or a scientific discipline well removed from the company's main line of activity would be a case in point. In addition, occasional hiring from the outside has one advantage: it can bring a new viewpoint into corporate councils, an injection of fresh ideas to challenge the accepted way as the best way. In general, however, the company with real investment merit is the company that usually promotes from within. This is because all companies of the highest investment order have developed a set of policies and ways of doing things peculiar to their own needs. If these special ways are truly worthwhile, it is always difficult and frequently impossible to retrain those long accustomed to them to different ways of getting things done. The higher up in an organization the newcomer may be, the more costly the indoctrination can be. While I can quote no statistics to prove the point, it is my observation that in better-run companies a surprising number of executives brought in close to the top tend to disappear after a few years. Of one thing the investor can be certain: a large company's need to bring in a new chief executive from the outside is a damning sign of something basically wrong with the existing management, no matter how good the surface signs may have been, as indicated by the most recent earnings statement. It may well be that the new president will do a magnificent job and in time will build a genuine management team around him so that such a jolt to the existing organization will never again become necessary. Consequently, in time such a stock may become one worthy of a wise investor. But such rebuilding can be so long and risky a process that, if an investor finds this sort of thing happening in one of his holdings, he will do well to review all his investment activities to determine whether his past actions have really been proceeding from a sound base. A worthwhile clue is available to all investors as to whether a management is predominantly one man or a smoothly working team. The annual salaries of top management of all publicly owned companies are made public in the proxy statements. If the salary of the number one man is very much larger than that of the next two or three, a warning flag is flying. If the compensation scale goes down rather gradually, it isn't. For optimum results for the investor, it is not enough that management personnel work together as a team and be capable of filling vacancies above them. There should also be present the greatest possible number of those vivid spirits of Ed Heller's people with the ingenuity and determination not to leave things just at their present, possibly quite satisfactory, state, but to build significant further improvements upon them. Such people are not easy to find. Motorola, Inc. has for some time been conducting an activity that the financial community has paid little or no attention to that indicates it is possible to accomplish dramatically more in this area than is generally considered possible. In 1967, Motorola management recognized that the rapid rate of growth anticipated in the years ahead would inevitably require steady expansion in the upper layers of management. It was decided to meet the problem head-on. In that year, Motorola opened its Executive Institute at Oracle, Arizona. It was designed so that, in an atmosphere remote from the daily details of the company's offices and plants, two things would happen. Motorola personnel of apparent unusual promise would be trained in matters beyond the scope of their immediate activities in order to be able to take on more important jobs. Top management would be furnished significant further evidence as to the degree of promotability of these same people. At the time of the Executive Institute's founding, skeptics within the management questioned whether the effort would be worth the cost. This was largely because of their belief that fewer than 100 people would be found in the whole Motorola organization with sufficient talent to make it worthwhile from the company's standpoint to provide them with this special training. Events have proven these skeptics spectacularly wrong. The Institute handles 5 to 6 classes a year, with 14 in each class. By mid-1974 about 400 Motorola people had gone through the school, and a significant number, including some present vice presidents, were found to have capabilities vastly greater than anything contemplated at the time they were approved for admission. Furthermore, those involved in this work feel that, from the company's standpoint, results in the more recent classes are even more favorable than in the earlier ones. It now appears that, as total employment at Motorola continues to expand with the company's growth, enough promising Motorola people can be found to maintain this activity indefinitely. All of this shows, from the investor's standpoint, that if enough ingenuity is used, even the companies with well above average growth rates can also grow the needed unusual people from within so as to maintain competitive superiority without running the high risk of friction and failure that so often occurs when a rapidly growing company must go to the outside for more than a very small part of its outstanding talent. Everyone has a personality, a combination of character traits that sets him or her apart from every other individual. Similarly, every corporation has its own ways of doing things, some formalized into well-articulated policies, others not, that are at least slightly different from those of other corporations. The more successful the corporation, the more likely it is to be unique in some of its policies. This is particularly true of companies that have been successful for a considerable period of time. In contrast to individuals, whose fundamental character traits change but little once they reach maturity, the ways of companies are influenced not only by outside events but by the reactions to those events of a whole series of different personalities who, as time goes on, follow one another in the top posts within the organization. However much policies may differ among companies, there are 3 elements that must always be present if a company's shares are to be worthy of holding for conservative, long-range investment. 1. The company must recognize that the world in which it is operating is changing at an ever-increasing rate. All corporate thinking and planning must be attuned to challenge what is now being done, to challenge it not occasionally but again and again. Every accepted way of doing things must be examined and re-examined to be as sure as is permitted by human fallibility that this way is really the best way. Some risks must be accepted in substituting new methods to meet changing conditions. No matter how comfortable it may seem to do so, ways of doing things cannot be maintained just because they worked well in the past and are hallowed by tradition. The company that is rigid in its actions and is not constantly challenging itself has only one way to go, and that way is down. In contrast, certain managements of large companies that have deliberately endeavored to structure themselves so as to be able to change have been those producing some of the most striking rewards for their shareholders. An example of this is the Dow Chemical Company, with a record of achievements over the last 10 years that is frequently considered to surpass that of any other major chemical company in this country, if not in the entire world. Possibly Dow's most significant departure from past ways was to break its management into 5 separate managements on geographical lines. It was believed that only in this way could local problems be handled quickly as best suited local conditions and without suffering from the bureaucratic inefficiencies that so often accompany bigness. The net effect of this, as told by the president of Dow Europe, the results that today challenge us are being made by our sister companies throughout the world. They, not our direct competitors, are turning in the gains that push us to be first. From the investor's standpoint, perhaps the most important feature of this change was not that it was made but that it was made when Dow still had a total sales volume much smaller than many other multinational companies that were operating successfully in the established way. In other words, change and improvement arose from innovative thinking to make a workable system better, not from a forced reaction to a crisis. This is but one of the many ways this pioneering company has broken with the past to attain its striking competitive record. Another was the unprecedented step for an industrial company of starting from scratch to make a success of a wholly owned bank in Switzerland so as to help finance the needs of its customers in the export market. Here again the management did not hesitate to break with the past in ways that engendered some risk in the early stages but that ended up by enhancing the intrinsic strength of the company. Many other examples could be cited from the record of this company. However, just one more will be mentioned merely to show the extreme variety of areas such actions may cover. Far earlier than most other companies, Dow not only recognized the need to spend sizable sums to avoid pollution but concluded that, if major results were to be attained, something more was needed than just exhortations from top management. It was necessary to obtain the consistent cooperation of middle-level managers. It was decided that the surest way of doing this was to appeal to the profit motives of those most directly involved. They were encouraged to find profitable methods of converting the polluting materials to saleable products. The rest is now business history. With the full power of top management, plant management, and highly skilled chemical engineers behind these projects, Dow has achieved a series of firsts in eliminating pollution that has won them the praise of many environmental groups that are usually quite anti-business in their viewpoints. Possibly more important, they have avoided hostility in most, although not all, of the communities where their plants are located. They have done this at very little overall dollar cost and in some cases at an operating profit. 2. There must always be a conscious and continuous effort, based on fact, not propaganda, to have employees at every level, from the most newly hired blue-collar or white-collar worker to the highest levels of management, feel that their company is a good place to work. This is a world that requires most of us to put in a substantial number of hours each week doing what is asked of us by others in order to receive a paycheck, even though we might prefer to spend those hours on our own amusement or recreation. Most people recognize the necessity for this. When a management can instill a belief, not just among a few top people but generally among the employees, that it is doing everything reasonably to be expected to create a good working environment and take care of its employees' interests, the rewards the company receives in greater productivity and lower costs can vastly outweigh the costs of such a policy. The first step in this policy is seeing that every employee is treated with reasonable dignity and consideration. A year or so ago I read in the press that a union official claimed that one of the nation's largest companies was compelling its production line employees to eat lunch with grease-stained hands because there was not sufficient time, with the number of washroom facilities available, for most of them to be able to wash before lunch. The stock of this company was of no investment interest to me for quite different reasons. Therefore, I have no knowledge of whether the charge was based on fact or was made in the heat of an emotional battle over wage negotiations. However, if true, this condition alone would, in my opinion, make the shares of this company unsuitable for holding by careful investors. Besides treating employees with dignity and decency, the routes to obtaining genuine employee loyalty are many and varied. Pension and profit-sharing plans can play a significant part. So can good communication to and from all levels of employees. Concerning matters of general interest, letting everyone know not only exactly what is being done but why frequently eliminates friction that might otherwise occur. Actually knowing what people in various levels of the company are thinking, particularly when that view is adverse, can be even more important. A feeling throughout the company that people can express their grievances to superiors without fear of reprisal can be beneficial, although this open-door policy is not always simple to maintain because of the time wasted by cranks and nuts. When grievances occur, decisions on what to do about them should be made quickly. It is the long smoldering grievance that usually proves the most costly. A striking example of the benefits that may be attained through creating a unity of purpose with employees is the People Effectiveness Program of Texas Instruments. The history of this program is an excellent example of how brilliant management perseveres with imperfects. Policies of this sort, even when new outside influences force some redirection of these policies. From the early days of this company, top management held a deep conviction that everyone would gain if a system could be set up whereby all employees participated in managerial-type decisions to improve performance, but that, to sustain interest on the part of employees, all participants must genuinely benefit from the results of their contributions. In the 1950s, semiconductor production was largely a matter of hand assembly, offering many opportunities for employees to make brilliant individual suggestions for improving performance. Meetings, even formal classes, were held in which production workers were shown how they could as individuals or groups show the way to improving operations. At the same time, through both profit-sharing plans and awards and honors, those participating benefited both financially and by feeling they were part of the picture. Then mechanization of these former manual operations started to appear. As this trend grew, there was somewhat less opportunity for certain types of individual contributions, as in certain ways the machines controlled what would be done. A few foremen within the organization began feeling that there was no longer a place for lower-level contributions to management-type participation. Top management took quite the opposite viewpoint. People participation would play a greater role than ever before. Now, however, it would be a group or team effort with the workers as a group estimating what could be done and setting their own goals for performance. Because workers started feeling that they were genuinely participating in decisions, not just being told what to do, and were being rewarded both financially and in honors and recognition, the results have been spectacular. In instance after instance, teams of workers have set for themselves goals quite considerably higher than anything management would have considered suggesting. At times when it appeared that targeted goals might not be met or when inter-team competition was producing rivalry, the workers proposed and voluntarily voted such unheard of things as cutting down on coffee breaks or shortening lunch periods to get the work out. The pressure of peer groups on the tardy or lazy worker who threatens the goals the group has set for itself dwarfs any amount of discipline that might be exerted from above through conventional management methods. Nor are these results confined to U.S. workers with their lifelong background in political democracy. They appear to be equally effective and mutually beneficial to people, regardless of the color of their skin and their origins from countries of quite different economic backgrounds. Though the performance goal plan was first initiated in the United States, equally striking results have appeared not just in Texas Instruments plants in the so-called developed industrial nations such as France and Japan but also in Singapore, with its native Asian employees, and in Curacao, where those on the payroll are overwhelmingly black. In all countries the morale effects appear striking when worker teams not only report directly to top management levels but also know their reports will be heeded and their accomplishments recognized and acknowledged. What all this has meant to investors was spelled out when company president Mark Shepard, Jr., addressed stockholders at the 1974 annual meeting. He stated that a People Effectiveness Index had been established consisting of the net sales billed divided by the total payroll. Since semiconductors, the company's largest product line, are one of the very few products in today's inflationary world that consistently decline in unit price, and since wages have been rising at the company's plants at rates from 7% a year in the United States to 20% in Italy and Japan, it would be logical to expect, in spite of improvements in people effectiveness, this index to decline. Instead it rose from about 2.25% in 1969 to 2.5% by the end of 1973. Furthermore, with definite plans for additional improvement and with further increases in profit-sharing funds tied into such improvement, it was announced that it was the company's goal to bring the index up to 3.1% by 1980, a goal that, if attained, would make the company a dramatically profitable place to work. Over the years Texas Instruments has frequently publicized some rather ambitious long-range goals and to date has rather consistently accomplished them. From the investment standpoint, there are some extremely important similarities in the three examples of people-oriented programs that were chosen to illustrate aspects of the second dimension of a conservative investment. It is a relatively simple matter to mention and give a general description of Motorola's Institute for Selecting and Training Unusual Talent to handle the growing needs of the company. It is an equally simple affair to mention that Dow found a means to stimulate people to work together to master environmental problems and to make them profitable for the company, or to state a few facts about the remarkable People Effectiveness Program at Texas Instruments. However, if another company decided to start programs like these from scratch, the problems that could arise might be infinitely more complicated than merely persuading a board of directors to approve the necessary appropriation. Programs of this kind are easy to formulate, but their implementation is a quite different matter. Mistakes can be very costly. It is not hard to imagine what might happen if a training school such as Motorola's selected the wrong people for promotion, with the result that the best junior talent quit the company in disgust. Similarly, suppose a company tried to follow, in general, a people effectiveness plan but either failed to create an atmosphere where workers genuinely felt themselves involved or failed to compensate their employees adequately, with the result that they became disillusioned. The misapplication of such a program could literally wreck a company. Meanwhile, companies that do perfect advantageous people-oriented policies and techniques usually find more and more ways to benefit from them. For these companies, such policies and techniques, these special ways of approaching problems and of solving them, are in a sense proprietary. For this reason they are of great importance to long-range investors. 3. Management must be willing to submit itself to the disciplines required for sound growth. It has already been pointed out that in this rapidly changing world companies cannot stand still. They must either get better or worse, improve or go downhill. The true investment objective of growth is not just to make gains but to avoid loss. There are very few companies whose managements will not make claims to being growth companies. However, a management that talks about being growth-oriented is not necessarily actually so oriented. Many companies seem to have an irresistible urge to show the greatest possible profits at the end of each accounting period to bring every possible cent down to the bottom line. This a true growth-oriented company can never do. Its focus must be on earning sufficient current profits to finance the costs of expanding the business. When adjustment for earning the required additional financial strength has been made, the company worthy of far-sighted investment will give priority to curtailing maximum immediate profits when there are genuine worthwhile opportunities for developing new products or processes, or for starting new product lines, or for any one of the 101 more mundane actions whereby a dollar spent today may mean many dollars earned in the future. Such actions can vary all the way from hiring and training new personnel that will be needed as the business grows to foregoing the greatest possible profit on a customer's order to build up his permanent loyalty by rushing something to him when he needs it badly. For the conservative investor, the test of all such actions is whether management is truly building up the long-range profits of the business rather than just seeming to. No matter how well known, the company with a policy that only gives lip service to these disciplines is not likely to prove a happy vehicle for investment funds. Neither is one that tries to follow these disciplines but falls down in executing them, as, for example, a company that makes large research expenditures but so mishandles its efforts as to gain little from them. 3. The third dimension. Investment characteristics of some businesses. The first dimension of a conservative stock investment is the degree of excellence in the company's activities that are most important to present and future profitability. The second dimension is the quality of the people controlling these activities and the policies they create. The third dimension deals with something quite different, the degree to which there does or does not exist within the nature of the business itself certain inherent characteristics that make possible an above-average profitability for as long as can be foreseen into the future. Before examining these characteristics, it may be well to point out why above-average profitability is so important to the investor, not only as a source of further gain but as a protection for what he already has. The vital role of growth in this connection has already been discussed. Growth costs money in many ways. Part of what otherwise would be the profit stream has to be diverted to experimenting, inventing, test marketing, new product marketing, and all the other operating costs of expansion, including the complete loss of the inevitable percentage of such expansion attempts that are bound to fail. Even more costly may be the additions to factories or stores or equipment that must be made. Meanwhile, as the business grows, more inventory will inevitably be needed to fill the pipelines. Finally, except for the very few businesses that sell only for cash, there will be a corresponding drain on corporate resources to take care of the growing volume of receivables. To accomplish all these things, profitability is vital. In inflationary periods, the matter of profitability becomes even more important. Usually when prices and, therefore, costs are rising on a broad front, a business can, in time, pass these costs along through higher prices of its own. However, this often cannot be done immediately. During the interim, obviously a much smaller bite is taken out of the profits of the broad profit margin company than occurs for its higher cost competition, since the higher cost company is probably facing comparably increased costs of doing business. Profitability can be expressed in two ways. The fundamental way, which is the yardstick used by most managements, is the return on invested assets. This is the factor that will cause a company to decide whether to go ahead with a new product or process. What percent return can the company expect on the part of its capital invested in this particular way in comparison to what the return might be if the same amount of its assets was employed in some other way? It is considerably more difficult for the investor to use this yardstick than it is for the corporate executive. What the investor usually sees is not the return on a specific amount of present-day dollars utilized in a specific subdivision of the business but the total earnings of the business as a percentage of its total assets. When the cost of capital equipment has risen as much as it has in the last 40 years, comparisons of the return on total invested capital between one company and another may be so distorted by variations in the price levels at which different companies made major expenditures that the figures are highly misleading. For this reason, comparing the profit margins per dollar of sales may be more helpful as long as one other point is kept in mind. This is that a company that has a high rate of sales in relation to assets may be a more profitable company than one with a higher profit margin to sales but a slower rate of sales turnover. For example, a company that has annual sales 3 times its assets can have a lower profit margin but make a lot more money than one that needs to employ $1 of assets in order to obtain each dollar of annual sales. However, while from the standpoint of profitability return on investment must be considered as well as profit margin on sales, from the standpoint of safety of investment all the emphasis is on profit margin on sales. Thus if two companies were each to experience a 2% increase in operating costs and were unable to raise prices, the one with a 1% margin of profit would be running at a loss and might be wiped out, while, if the other had a 10% margin, the increased costs would wipe out only 1/5 of its profits. There is one final matter to be kept in mind in order to place this dimension of conservative investing in proper perspective. In today's highly fluid and competitive business world, obtaining well above average profit margins or a high return on assets is so desirable that, whenever a company accomplishes this goal for any significant period of time, it is bound to be faced with a host of potential competitors. If the potential competitors actually enter the field, they will cut into markets the established company now has. Normally, when potential competition becomes actual competition, the ensuing struggle for sales results in anything from a minor to a major reduction in the high profit margin that had theretofore existed. High profit margins may be compared to an open jar of honey owned by the prospering company. The honey will inevitably attract a swarm of hungry insects bent on devouring it. In the business world there are but 2 ways a company can protect the contents of its honey jar from being consumed by the insects of competition. One is by monopoly, which is usually illegal, although, if the monopoly is due to patent protection, it may not be. In any event, monopolies are likely to end quite suddenly and do not commend themselves as vehicles for the safest type of investing. The other way for the honey jar company to keep the insects out is to operate so much more efficiently than others that there is no incentive for present or potential competition to take action that will upset the existing situation. Now let us turn from this background discussion of relative profitability to the heart of the third dimension of conservative investing, namely, the specific characteristics that enable certain well-managed companies to maintain above-average profit margins more or less indefinitely. Possibly the most common characteristic is what businessmen call the economies of scale. A simple example of economy of scale: a well-run company making 1 million units a month will often have a lower production cost for each unit than a company producing only 100,000 units in the same period. The difference between the cost per unit of these two companies, one 10 times larger than the other, can vary considerably from one line of business to another. In some there may be almost no difference at all. Furthermore, it should never be forgotten that in any industry the larger company will have a maximum advantage only if it is exceedingly well run. The bigger a company is, the harder it is to manage efficiently. Quite often the inherent advantages of scale are fully balanced or even more than balanced by the inefficiencies produced by too many bureaucratic layers of middle management, consequent delays in making decisions, and, at times, the seeming inability of top executives in the largest companies to know quickly just what needs corrective attention in various subdivisions of their far-flung complexes. On the other hand, when a company clearly becomes the leader in its field, not just in dollar volume but in profitability, It seldom gets displaced from this position as long as its management remains highly competent. As discussed in examining the second dimension of a conservative investment, such a management must retain the ability to change corporate ways to match the ever-changing external environment. There is a school of investment thinking that advocates acquiring shares in the number 2 or 3 company in a field because these can go up to number 1, whereas the leader is already there and might slip. There are some industries where the largest company does not have a clear leadership position, but, where it does, we emphatically do not agree with this viewpoint. It has been our observation that, in many years of trying, Westinghouse has not surpassed General Electric, Montgomery Ward has not overtaken Sears, and once IBM established early dominance in its areas of the computer market, even the extreme efforts of some of the largest companies in the country, including General Electric, did not succeed in displacing IBM from its overwhelming share of that market. Neither have scores of smaller price-cutting suppliers of peripheral equipment been able to displace IBM as the main and most profitable operator in that phase of the computer industry. What enables a company to obtain this advantage of scale in the first place? Usually getting there first with a new product or service that meets worthwhile demand and backing this up with good enough marketing, servicing, product improvement, and, at times, advertising to keep existing customers happy and coming back for more. This frequently establishes an atmosphere in which new customers will turn to the leader largely because that leader has established such a reputation for performance that no one is likely to criticize the buyer adversely for making this particular selection. In the heyday of the attempts of others to cut into IBM's computer business, no one will ever know how many employees of corporations planning to use a computer for the first time recommended IBM rather than a smaller competitor whose equipment they privately thought was better or cheaper. In such instances, the primary motive was probably a feeling that if, later on, the equipment should fail to perform, those making the recommendation would not be blamed if they had chosen the industry leader but could very well find their necks out a mile if a failure occurred and they had chosen a smaller company without an established reputation. There is a saying in the pharmaceutical industry that, when a truly worthwhile new drug is created, the company that gets in first takes and holds 60% of the market, thereby making by far the bulk of the profits. The next company to introduce a competitive version of the same product gets perhaps 25% of the market and makes moderate profits. The next 3 companies to arrive divide perhaps 10% to 15% of the market and earn meager profits. Any further entrants usually find themselves in a quite unhappy position. A trend toward the substitution of generic for trade names may or may not upset these ratios, and in any case there cannot be said to be an exact formula applicable to other industries. Nevertheless, the concept behind them should be kept in mind when an investor attempts to appraise which companies have a natural advantage in regard to profitability and which do not. Lower production costs and greater ability to attract new customers because of a well-recognized trade name are not the only ways that scale can consistently give a company competitive strength. Examining some of the factors behind the investment strength of the soup division of the Campbell Soup Company is illuminating. In the first place, as by far the largest soup canners in the nation, this company can reduce total costs through backward integration as smaller companies cannot. Making many of their own cans exactly to meet their own needs is a case in point. More important, Campbell has enough business so that it can scatter canning plants at strategic spots across the nation, which makes for a sizable double advantage. It is both a shorter haul for the grower delivering his produce to the cannery and a shorter average haul from cannery to supermarket. Since canned soup is heavy in relation to its value, freight costs are significant. This puts the smaller canner with only 1 or 2 plants at a big disadvantage in trying to compete in a nationwide market. Next, and probably most important of all, because Campbell's is a recognized product that the customer knows and wants when he enters the supermarket, the retailer automatically awards to it a prominent and fairly sizable area of his always sought-after shelf space. In contrast, he is usually quite reluctant to do as much for a less-known or unknown competitor. This prominent shelf space helps to sell the soup and is still another factor tending to keep the number 1 company on top, a factor extremely discouraging for potential competitors. Also discouraging for them is Campbell's normal advertising budget, which adds very much less to the cost per can sold than such a budget would for a competitor with a very much smaller output. For reasons such as these, this particular company has strong inherent forces tending to protect profit margins. However, to present a complete picture, we must note some influences working in the opposite direction. When Camel's own costs rise, as they can do sharply in an inflationary period, prices to the consumer cannot be raised more than the average of other foods, or there could be a shift in demand away from soups to other staples. Far more important, Campbell has a major competitor that most companies do not have to contend with, and that, as rising production costs cause higher prices to the consumer, can cut significantly into Camel's market. This is the American housewife fighting her battle of the budget by making soup in her own kitchen. This point is mentioned merely to show that even when scale affords huge competitive advantages and a company is well run, these characteristics, important as they are, do not, of themselves, assure extreme profitability. Scale is by no means the only investment factor tending to perpetuate the much greater profitability and investment appeal of some companies over others. Another which we believe is of particular interest is the difficulty of competing with a highly successful, established producer in a technological area where the technology depends on not one scientific discipline but the interplay of two or preferably several quite different disciplines. To explain what I mean, let us suppose that someone develops an electronic product that promises to open up sizable new markets in either the computer or instrument field. There are enough highly capable companies in both areas that have in-house experts able to duplicate both the electronic hardware and the software programming that such products require, so that if the new market appears large enough, sufficient competition may soon develop to make the profits of the smaller innovator rather tenuous. In areas such as these, the successful large company has a further built-in advantage. Many such lines cannot be sold unless a network of service people is available to make rapid repair at the customer's locations. The large established company usually has such an organization in being. It is extremely difficult and expensive for a small new company introducing a worthwhile new product to establish such a network. It may be even harder for the new company to convince a potential buyer that it has the financial staying power not only to have the service network in place when the sale is made but to keep it there in the future. Furthermore, while all these influences have made it difficult in the past for the newcomer with an exciting product to establish real leadership in most subdivisions of the electronics industry, although a few companies have done so, it is likely to be still more difficult in the future. This is because the semiconductor is becoming a larger and larger percentage of both the total content and the total technical know-how of more and more products. The leading companies making these devices also now have at least as much in-house knowledge as the top old-line computer and instrument companies if they elect to compete in many new product areas that are largely electronic. A case in point is the dramatic success of Texas Instruments in the sensationally growing area of handheld calculators and the difficulties of some of the early pioneers in this field. However, notice how the balance changes if, instead of just a technology based on electronic hardware and software, producing the product calls for these skills to be combined with some quite different ones such as nucleonics or some highly specialized area of chemistry. The large electronic companies simply do not have the in-house skills to enter these interdisciplinary technologies. This affords the best-run innovators a far better opportunity to build themselves into the type of leadership position in their particular product line that carries with it the broad profit margin that tends to continue as long as managerial competence does not weaken. I believe that some of these multidisciplinary technological companies, in not all of which is electronics a significant factor, have recently proven some of the finest opportunities for truly far-sighted investing. I am inclined to think that more such opportunities will occur in the future. Thus, for example, I suspect that sometime in the future new leading companies will arise through products or processes that utilize some of these other disciplines combined with biology, although so far I have not seen any company in this area that so qualifies. This is not to say that none exists. Technological development and scale are not the only aspects of a company's activities in which unusual circumstances may raise opportunities for sustained high profit margins. In certain circumstances these can also occur in the area of marketing or sales. An example is a company that has created in its customers the habit of almost automatically specifying its products for reorder in a way that makes it rather uneconomical for a competitor to attempt to displace them. Two sets of conditions are necessary for this to happen. First, the company must build up a reputation for quality and reliability in a product that the customer recognizes as very important for the proper conduct of his activities, where an inferior or malfunctioning product would cause serious problems, where no competitor is serving more than a minor segment of the market, so that the dominant company is nearly synonymous in the public mind with the source of supply, and yet the cost of the product is only a quite small part of the customer's total cost of operations. Consequently, moderate price reductions yield only very small savings in relation to the risk of taking a chance on an unknown supplier. However, even this is not enough to ensure that a company fortunate enough to get itself in this position will be able to enjoy above-average profit margins year after year. Second, it must have a product sold to many small customers rather than a few large ones. These customers must be sufficiently specialized in their nature that it would be unlikely for a potential competitor to feel they could be reached through advertising media such as magazines or television. They constitute a market in which, as long as the dominant company maintains the quality of its product and the adequacy of its service, it can be displaced only by informed salesmen making individual calls. Yet the size of each customer's orders makes such a selling effort totally uneconomical. A company possessing all these advantages can, through marketing, maintain an above-average profit margin almost indefinitely unless a major shift in technology should displace it. Companies of this type can most often be found in the moderately high-technology supply area. One of their characteristics is to maintain their image of leadership by holding frequent technical seminars on the use of their product, a marketing tool that proves highly effective once a company attains this type of position. It should be noted that the above-average profit margin or greater than normal return on investment need not be, in fact, should not be many times that earned by industry in general to give a company's shares great investment appeal. Actually, if the profit or return on investment is too spectacular, it can be a source of danger, as the inducement then becomes almost irresistible for all sorts of companies to try to compete so as to get a share of the unusual honey pot. In contrast, a profit margin consistently just 2 or 3% of sales greater than that of the next best competitor is sufficient to ensure a quite outstanding investment. To summarize the matter of the third dimension of a truly conservative investment, it is necessary not just to have the quality of personnel discussed in the second dimension, but to have had that personnel steer the company into areas of activity where there are inherent reasons within the economics of the particular business, so that above-average profitability is not a short-term matter. Put simply, the question to ask in regard to this third dimension is, what can the particular company do that others would not be able to do about as well? If the answer is almost nothing, so that, as the business gets more prosperous, others can rush in to share in the company's prosperity on about equal terms, the evidence is conclusive that while the company's stock may be cheap, the investment fails to qualify as to this third dimension. 4. The fourth dimension. Price of a conservative investment. The fourth dimension of any stock investment involves the price-earnings ratio, that is, the current price divided by the earnings per share. In the attempt to appraise whether the price-earnings ratio is in line with the proper valuation for that specific stock, trouble begins to arise. Most investors, including many professionals who should know better, become confused on this point because they don't have a clear understanding of what makes the price of the particular stock go up or down by a significant amount. This misunderstanding has resulted in losses in billions of dollars by investors who find out later that they own stocks bought at prices that they never should have paid. Even more billions have been lost as investors have sold out, at the wrong time and for the wrong reasons, shares they had every reason to hold and which, if held, would have become extremely profitable as long-range investments. Still another result is one that, if it happens repeatedly, will seriously impair the ability of deserving corporations to obtain adequate financing, with all that this could mean in a lower standard of living for everyone. Every time individual stocks take sickening plunges, another group of badly burned investors places the blame on the system rather than on their own mistakes or those of their advisors. They conclude that common stocks of any type are not suitable for their savings. The other side of the coin is that many other investors can be found who over the years have prospered mightily from holding the right stocks for considerable periods of time. Their success may be due to understanding basic investment rules. Or it may be due to just plain good luck. However, the common denominator in this success has been the refusal to sell certain unusual high-quality stocks simply because each has had such a sharp fast rise that its price-earnings ratio suddenly looks high in relation to that to which the investment community had become accustomed. In view of the importance of all this, it is truly remarkable that so few have looked beneath the surface to understand exactly what causes these sharp price changes. Yet the law that governs them can be stated reasonably simply: every significant price move of any individual common stock in relation to stocks as a whole occurs because of a changed appraisal of that stock by the financial community. Let us see how this works in practice. 2 years ago, Company G was considered quite ordinary. It had earned $1 per share and was selling at 10 times earnings, or $10. During these last 2 years, most companies in its industry have been showing a downward profit trend. In contrast, a series of brilliant new products, combined with better profit margins on old products, enabled G Company to report $1.40 per share last year and $1.82 this year, and to give promise of further gains over the next several years. Obviously, the actions within the company that produced the sharp contrast between G's recent results and those of others in the industry could not have started just 2 years ago but must have been going on for some time, otherwise the operating economies and the brilliant new products would not have occurred. However, belated recognition of how well G is qualifying in regard to matters covered in our discussions of the first 3 dimensions has now caused the price-earnings ratio to rise to 22. When compared with other stocks showing similar above-average business characteristics and comparable growth prospects, this ratio of 22 does not appear at all high. Since 22 times $1.82 is $40, here is a stock that has legitimately gone up 400% in 2 years. Equally important, a record such as G's is frequently an indication that there is now a functioning management team capable of continued growth for many years ahead. Such a growth, even at a more modest rate averaging, say, 15% in the next decade or two, could easily result in profits by that time running into the thousands rather than the hundreds of percent. The matter of appraisal is the heart of understanding the seeming vagaries of price-earnings ratios. It should never be forgotten that an appraisal is a subjective matter. It has nothing necessarily to do with what is going on in the real world about us. Rather, it results from what the person doing the appraising believes is going on, no matter how far from the actual facts such a judgment may be. In other words, any individual stock does not rise or fall at any particular moment in time because of what is actually happening or will happen to that company. It rises or falls according to the current consensus of the financial community as to what is happening and will happen, regardless of how far off this consensus may be from what is really occurring or will occur. At this point, many pragmatic individuals simply throw up their hands in disbelief. If the huge price changes that occur in individual stocks are made solely because of changed appraisals by the financial community, with these appraisals sometimes completely at variance with what is going on in the real world of a company's affairs, what significance have the other 3 dimensions? Why bother with the expertise of business management, scientific technology, or accounting at all? Why not just depend on psychologists? The answer involves timing. Because of a financial community appraisal that is at variance with the facts, a stock may sell for a considerable period for much more or much less than it is intrinsically worth. Furthermore, many segments of the financial community have the habit of playing follow the leader, particularly when that leader is one of the larger New York City banks. This sometimes means that when an unrealistic appraisal of a stock is already causing it to sell well above what a proper recognition of the facts would justify, the stock may stay at this too high level for a long period of time. Actually, from this already too high a price it may go even higher. These wide variations between the financial community's appraisal of a stock and the true set of conditions affecting it may last for several years. Always, however, sometimes within months, sometimes only after a much longer period of time, the bubble bursts. When a stock has been selling too high because of unrealistic expectations, sooner or later a growing number of stockholders grow tired of waiting. Their selling soon more than exhausts the buying power of the small number of additional buyers who still have faith in the old appraisal. The stock then comes tumbling down. Sometimes the new appraisal that follows is quite realistic. Frequently, however, as this re-examination evolves under the emotional pressure of falling prices, the negative is overemphasized, resulting in a new financial community appraisal that is significantly less favorable than the facts warrant and that may then prevail for some time. However, when this happens, much the same thing occurs as when the appraisal is too favorable. The only difference is that the process is reversed. It may take months or years for a more favorable image to supplant the existing one. Nevertheless, as pleasing earnings mount upward, sooner or later this happens. Fortunate holders, those who don't sell out as such a stock starts to rise, then benefit from the phenomenon that provides the greatest reward in relation to the risk involved the stock market can produce. This is the dramatic improvement in price that results from the combined effect of both a steady improvement in per-share earnings and a sharp, simultaneous increase in the price-earnings ratio. As the financial community quite correctly discovers that the fundamentals of the company have much more investment worth than had been recognized when the old image was in effect, the resulting increase in the price-earnings ratio is frequently an even more important factor in the increased price of the stock than the actual increase in per-share earnings that accompanies it. This is precisely what happened in our company example. We are now in a position to begin to get a true perspective on the degree of conservatism, that is, of basic risk in any investment. On the lowest end of the risk scale and most suitable for wise investment is the company that measures quite high in regard to the first three dimensions but currently is appraised by the financial community as less worthy, and therefore has a lower price-earnings ratio, than these fundamental facts warrant. Next least risky and usually quite suitable for intelligent investment is the company rating quite high in regard to the first three dimensions and having an image and therefore a price-earnings ratio reasonably in line with these fundamentals. This is because such a company will continue to grow if it truly has these attributes. Next least risky and, in my opinion, usually suitable for retention by conservative investors who own them but not for fresh purchase with new funds, are companies that are equally strong in regard to the first three dimensions but, because these qualities have become almost legendary in the financial community, have an appraisal or price-earnings ratio higher than is warranted by even the strong fundamentals. In my opinion, there are important reasons such stocks should usually be retained, even though their prices seem too high. If the fundamentals are genuinely strong, these companies will in time increase earnings not only enough to justify present prices but to justify considerably higher prices. Meanwhile, the number of truly attractive companies in regard to the first three dimensions is fairly small. Undervalued ones are not easy to find. The risk of making a mistake and switching into one that seems to meet all of the first three dimensions but actually does not is probably considerably greater for the average investor than the temporary risk of staying with a thoroughly sound but currently overvalued situation until genuine value catches up with current prices. Investors who agree with me on this particular point must be prepared for occasional sharp contractions in the market value of these temporarily overvalued stocks. On the other hand, it is my observation that those who sell such stocks to wait for a more suitable time to buy back these same shares seldom attain their objective. They usually wait for a decline to be bigger than it actually turns out to be. The result is that some years later, when this fundamentally strong stock has reached peaks of value considerably higher than the point at which they sold, they have missed all of this later move and may have gone into a situation of considerably inferior intrinsic quality. Continuing up our scale of ascending risks, we come next to the stocks that are average or relatively low in quality in regard to the first three dimensions but have an appraisal in the financial community either lower than, or about in line with, these not very attractive fundamentals. Those with a poorer appraisal than basic conditions warrant may be good speculations but are not suitable for the prudent investor. In the fast-moving world of today, there is just too much danger of adverse developments severely affecting such shares. Finally, we come to what is by far the most dangerous group of all, companies with a present financial community appraisal or image far above what is currently justified by the immediate situation. Purchase of such shares can cause the sickening losses that tend to drive investors away from stock ownership in droves and threaten to shake the investment industry to its foundations. If anyone wants to make a case-by-case study of the contrast between the financial community appraisals that prevailed at one time about some quite colorful companies and the fundamental conditions that subsequently came to light, he will find plenty of material in a business library or the files of the larger Wall Street houses. It is alarming to read some of the reasons given in brokerage reports recommending purchase of these shares and then to compare the outlook described in such documents with what actually was to happen. A fragmentary list of such companies might include Memorex High 173, Ampex High 49, Levitt's Furniture High 61/2, Mohawk Data Sciences High 111, Litton Industries High 101/3, Calver High 176/1/2. The list could go on and on and on. However, more examples would serve only to make the same point over and over. Since it should already be quite apparent how important is the habit of evaluating any difference that may exist between a contemporary financial community appraisal of a company and the fundamental aspects of that company, it should be more productive for us to spend our time examining further the characteristics of these financial community appraisals. First, however, to avoid risk of misunderstanding, it seems advisable to avoid semantic confusion by defining two of the words in our original statement of the rule governing all major changes in the price of common stocks. Every significant price move of any individual common stock in relation to stocks as a whole occurs because of a changed appraisal of that stock by the financial community. The phrase, significant price changes, is used rather than merely price changes. This is to exclude the kind of minor price variation that occurs if, say, an estate has 20,000 shares of a stock that a clumsy broker rapidly dumps on the market, with the result that the stock drops a point or two and then usually recovers as the liquidation ends. Similarly, at times an institution will determine that on going into a new situation it must buy a minimum number of shares. The result is frequently a small one-time bulge that subsides on completion of this sort of buying. Such moves, in the absence of a genuinely changed appraisal of the company by the financial community as a whole, have no important or long-term effect on the price of the shares. Usually such small price changes disappear once the special buying or selling is over. The term, financial community, has been used to include all those able and enough interested to be potentially ready to buy or sell a particular stock at some price, keeping in mind that, with regard to impact on price, the importance of each of these potential buyers and sellers is weighted by the amount of buying or selling power each is in a position to exercise. 5. More about the fourth dimension. Up to this point, our discussion of the financial community's appraisal of a stock may have given the impression that this appraisal is nothing more than an evaluation of that particular equity, considered by itself. This is oversimplification. Actually, it always results from the blending of three separate appraisals: the current financial community appraisal of the attractiveness of common stocks as a whole, of the industry of which the particular company is a part, and, finally, of the company itself. Let us first examine the matter of industry appraisals. Everyone knows that, over long periods of time, there can be a sizable decline in the price-earnings ratio the financial community will pay to participate in an industry as it passes from an early stage when huge markets appear ahead to a much later period where it, in turn, may be threatened by new technologies. Thus, in the early years of the electronics industry, companies making electronic tubes, in that period the fundamental building block of all electronics, sold at very high price-earnings ratios. Then price-earnings ratios shrank drastically as the development of semiconductors steadily narrowed the tube market. Makers of magnetic memory devices have more recently suffered the same fate for the same reason. All this is obvious and thoroughly understood. What is not so obvious or comparably understood is how the image of an industry can rise or fall in financial community status, not because of such overpowering influences as these but because at a given time the financial community is stressing one particular set of industry background influences rather than another. Yet both sets of background conditions may have been quite valid for some time, and both may give every indication of continuing to be for the reasonable future. The chemical industry may be cited as an example. From the depths of the Great Depression until the middle 1950s, the shares of the largest U.S. chemical companies sold at quite high price-earnings ratios compared to most other stocks. The financial community's idea of these companies might have been depicted in a cartoon as an endless conveyor belt. At one end were scientists making breathtaking new compounds in test tubes. After passing through mysterious and hard-to-imitate factories, these materials came out at the other end as fabulous new products such as nylon, DDT, synthetic rubber, quick-drying paint, and endless other new materials that seemed sure to be an ever-increasing source of wealth for their fortunate producers. Then, as the 1960s arrived, the image changed. The chemical industry, to the investment community, came to resemble steel or cement or paper in that it was selling bulk commodities on a basis of technical specification so that Jones's chemicals were more or less identical with Smith's. Capital-intensive industries usually are under major pressure to operate at high rates of capacity in order to amortize their large fixed investments. The result is frequently intense price competition and narrowing profit margins. This changed image caused the shares of the major chemical companies to sell at significantly lower price-earnings ratios in relation to stocks as a whole in the, say, 10-year period that ended in 1972 than they had in the past. While still considerably higher than in many industries, chemical price-earnings ratios started more closely to resemble those of industries like steel, paper, and cement. Now the remarkable thing about all this is that with one important exception there was little or nothing different in the fundamental background of this industry in the 1960s than there was in the prior 30 years. It is true that in the latter half of the 1960s there was a serious glut of capacity in certain areas such as the manufacture of most synthetic textile products. This was a major temporary depressant of the earnings of certain of the leading chemical companies, particularly DuPont. But the basic characteristics of the industry had in no way changed sufficiently to account for this rather drastic change in the industry's status in the financial community. Chemical manufacture always had been capital-intensive. Most products had always been sold on a technical specification basis so that Jones could seldom raise his price above Smith's. On the other hand, as a host of new and greatly improved pesticides, packaging materials, textiles, drugs, and countless other products have shown, the 1960s and the 1970s have afforded this industry an ever-expanding market. Opportunities seem almost limitless for human brains to rearrange molecules so as to create products not found in nature that will have special properties to cater to the needs of man better or more cheaply than the previously used natural materials. Finally, in both the previous period of higher and the more recent period of lower esteem for chemical stocks, still another factor had remained almost constant. The older and larger volume chemical products, representing in a sense the first step processing of tailored materials from such basic sources of molecules as salt or hydrocarbons, were inevitably products sold mainly by specification and on a price-competitive basis. Nevertheless, for the Alert Company there always was and continued to be the opportunity to process these first-step products into much more complicated and higher-priced ones. These, at least for a while, could be sold on a much more proprietary and therefore less competitive basis. As these products in turn become price competitive, the Alert Companies have consistently found still newer ones to add to the higher profit margin end of their lines. In other words, all the favorable factors, so much in the financial community's mind when chemical stocks were darlings of the market, continued to be there after they had lost considerable status. But the unfavorable factors so much in the forefront in the 1960s were also there in the earlier period when they were largely ignored. What had shifted was the emphasis, not the facts. But the facts, too, can change. Starting about the middle of 1973, chemical stocks began regaining favor in the financial community. This was because a new view of the industry was starting to prevail. In the scarcity-plagued economy the major industrial nations have been experiencing for the first time in modern times, manufacturing capacity can be increased only gradually, hence, it may be years before cutthroat price competition will occur again. This image opens up a whole new ballgame for the investor in chemical stocks. The problem for investors now becomes one of determining whether the background facts warrant the new image and, if they do, whether chemical stocks, in relation to the market as a whole, have risen more than or not as much as may be warranted by the new situation. Recent financial history offers countless other examples of much larger changes in price-earnings ratios that occurred because the financial community's appraisal of the industry's background changed radically while the industry itself remained almost exactly the same. In 1969, the computer peripheral stocks were great market favorites. These were the companies making all the special equipment that could be added to the central computing unit or mainframe of a computer to increase the user's benefits from that central unit. High-speed printers, extra memory units, and keyboard devices to eliminate the need for key punch operators in getting data into a computer were some of the major products in this group. The prevailing image then was that these companies had an almost limitless future. While the central computer itself was largely developed and its market would be dominated by a few strong, established companies, the small independent would be able to undercut the big companies in these peripheral areas. Today there is a new awareness of the financial strain on small companies with products that are usually leased rather than sold and of the determination of the major computer mainframe manufacturers to fight for the market of the products hung on their equipment. Have the fundamentals changed, or is it the appraisal of the fundamentals that has changed? An extreme case of a changed appraisal is the way in which the financial community looked on the fundamentals of the franchising business and franchise stocks in 1969 in contrast to 1972. Here again, as with computer peripheral stocks, all the problems of the industry were inherently there when these stocks were being bought at such high price-earnings ratios but were being overlooked when the prevailing image was one of uninterrupted growth for the company momentarily doing well. In this whole matter of industry image, the investor's problem is always the same. Is the current prevailing appraisal one more favorable, less favorable, or about the same as that warranted by the basic economic facts? At times this can present an acute problem to even the most sophisticated investors. One example occurred in December 1958 when Smith, Barney & Co., traditionally conservative investment bankers, took a pioneering step that seems purely routine today but appeared quite the contrary at that time. They made a public offering of the equity shares of the A.C. Nielsen Co. This company had no factories, no tangible product, and therefore no inventories. Instead it was in the service business, receiving fees for supplying market research information to its customers. It was true that in 1958 banks and insurance companies had long been well regarded in the marketplace as industries worthy of conservative investment. However, such industries were hardly comparable. Since the book value of a bank or insurance company is in cash, liquid investments, or accounts receivable, the investor buying a bank or insurance stock seemed to have a hard core of value to fall back on that did not exist for this new kind of service company being introduced to the financial public. However, investigation of the A.C. Nielsen situation revealed unusually good fundamentals. There was an honest and capable management, a uniquely strong competitive position and good prospects for many years of further growth. Nevertheless, until experience showed how the financial community would react to its first exposure to this kind of an industry, there did appear to be some reason for hesitation in buying. Would it take years for a realistic appraisal of the investment worth of such a company to displace the fear that might be engendered by the lack of some of the familiar yardsticks of value? It may seem ridiculous today, when for many years a company like A.C. Nielsen has enjoyed a price-earnings ratio signifying a very high investment appraisal, but some of us who decided to take a chance on the fundamentals being recognized and bought these shares at that time experienced a sensation almost like stepping off a cliff and seeing if the air would support us. So new was the concept of a service company in contrast to concepts to which we were accustomed. Actually, within a few years the pendulum swung quite the other way. As A.C. Nielsen's profits grew and grew, a new concept arose in Wall Street. A large number of companies, many quite different in economic fundamentals but all dealing in services rather than products, were lumped together in a financial community image as parts of a highly attractive service industry. Some began selling at higher price-earnings ratios than they might have deserved. As always, in time, fundamentals dominated, and this false image formed by lumping quite different companies into one group faded away. This point cannot be overstressed. The conservative investor must be aware of the nature of the current financial community appraisal of any industry in which he is interested. He should constantly be probing to see whether that appraisal is significantly more or less favorable than the fundamentals warrant. Only by judging properly on this point can he be reasonably sure about one of the three variables that will govern the long-term trend of market price of stocks of that industry. 6. Still more about the fourth dimension. The financial community's appraisal of a company's own characteristics is an even more important factor in the price-earnings ratio than is the appraisal of the industry in which the company is engaged. The most desirable investment traits of individual companies have been defined in our discussion of the first three dimensions of a conservative investment. In general, the more closely the financial community's appraisal of a particular stock approaches these characteristics, the higher will be its price-earnings ratio. To the degree by which it falls below these standards, the price-earnings ratio will tend to decline. The investor can best determine which stocks are importantly undervalued or overvalued by a shrewd determination of the degree to which the real facts concerning any particular company present an investment situation significantly better or significantly worse than that painted by the current financial image of that company. In making a determination as to the relative attractiveness of two or more stocks, investors often confuse themselves by attempting too simple a mathematical approach to such a problem. Let us suppose, for example, they compare two companies, the profits of each of which, after careful study, appear to afford prospects of growing at a rate of 10% a year. If one is selling at 10 times earnings and the other at 20 times, the stock selling at 10 times earnings appears cheaper. It may be. It also may not be. There can be a number of reasons for this. The seemingly cheaper company may have such a leveraged capitalization that the danger of interruption of the expected growth rate may be much greater in the lower price-earnings ratio stock. Similarly, for purely business reasons, while the growth rate would seem a most probable estimate for both stocks, nevertheless the chance of the unexpected upsetting these estimates may be considerably more for the one stock than for the other. Another far more important and far less understood way to reach wrong conclusions is to rely too much on simple comparisons of the price-earnings ratios of stocks that seem to be offering comparable opportunities for growth. To illustrate this, let us assume that there are two stocks with an equally strong prospect of doubling earnings over the next 4 years and that both are selling at 20 times earnings, while in the same market companies which are sound otherwise but have no growth prospects are selling at 10 times earnings. Let us suppose that 4 years later the price-earnings ratios of stocks as a whole are unchanged so that generally sound stocks, but ones with no growth prospects, are still selling at 10 times earnings. Let us also suppose that at this same time, 4 years later, one of our two stocks has much the same growth prospects for the time ahead as it had 4 years before, so that the financial community's appraisal is that this stock should again double its earnings over the next 4 years. This means it would still be selling at 20 times the doubled earnings of the past 4 years, or, in other words, that it had also doubled in price in that period. In contrast, at this same time, 4 years after our example had started, the second stock had also doubled its earnings, just as had been expected, but at this point the financial community's appraisal is for flat earnings in an otherwise sound company over the next 4 years. This would mean that owners of this second stock were in for a market disappointment even though the 4-year doubling of earnings had come through exactly as forecast. With an image of no growth in earnings for the next 4 years, they would now be seeing a price-earnings ratio of only 10 in this second stock. Therefore, while the earnings had doubled, the price of the stock had remained the same. All this can be summarized in a basic investment rule: the further into the future profits will continue to grow, the higher the price-earnings ratio an investor can afford to pay. This rule, however, should be applied with great caution. It should never be forgotten that the actual variations in price-earnings ratio will result not from what will actually happen but from what the financial community currently believes will happen. In a period of general market optimism, a stock may sell at an extremely high price-earnings ratio because the financial community quite correctly envisages many years of great growth ahead. But many years will have to elapse before this growth is fully realized. The great growth that had been correctly discounted in the price-earnings ratio is likely to become undiscounted for a while, particularly if the company experiences the type of temporary setback that is not uncommon for even the best of companies. In times of general market pessimism, this kind of undiscounting of some of the very finest investments can reach rather extreme levels. When it does, it affords the patient investor, with the ability to distinguish between current market image and true facts, some of the most attractive opportunities common stocks can offer for handsome long-term profits at relatively small risk. A rather colorful example of how sophisticated investors attempt to anticipate a changed investment community appraisal of a company occurred on March 13, 1974. The previous day the New York Stock Exchange closing price of Motorola was 48. On March 13 the closing quotation was 60, a gain of almost 25%. What had happened was that after the close of the exchange on the 12th, an announcement was made that Motorola was getting out of the television business and was selling its U.S. television plants and inventory to Matsushita, a large Japanese manufacturer, for approximate book value. Now it had been known generally that Motorola's television business was operating at a small loss and to that extent was draining the profits of the rest of the company's business. This of itself would warrant the news to cause some increase in the price of the shares, although hardly the degree of rise that actually occurred. Considerably more complex reasoning was the main motivation behind the buying. For some time a considerable body of investors had believed that Motorola's profitable divisions, particularly its communications division, made this company one of the very few American electronics companies qualified as being of truly high-grade investment status. For example, Spencer Trask & Co. had issued a report by security analyst Otis Bradley that discussed the investment merits of Motorola's communications division in considerable detail. This report took the unusual approach of calculating the current and estimated future price-earnings ratio, not for Motorola's earnings as a whole but merely for this one division alone. The report compared the estimated sales volume and price-earnings ratio of just this one division with those of Hewlett-Packard and PerkinElmer, generally considered to be among the very finest of electronics companies from an investment standpoint. From the report the inference could easily be drawn that the investment quality of Motorola's communications division was such that it was worth, by itself, the then current price of Motorola shares so that, in effect, a buyer of the stock was getting all the other divisions for nothing. With this opinion about Motorola existing in some highly sophisticated places, what may be judged to have induced such eager buying on the Matsushita news? These Motorola enthusiasts had long known that many elements of the financial community were inclined to look with disfavor on the stock because of its television manufacturing image. Most of the financial community, upon hearing Motorola, first thought of television and secondly of semiconductors. At the time of the Matsushita announcement, Standard & Poor's stock guide, in the small amount of space available for listing the principal business of each company, described Motorola as radio and TV, semiconductors, all of which, though not inaccurate, was misleading in that it suggested a different sort of company from what, in fact, Motorola really was, and completely overlooked the very important communications division, which at the time comprised almost half of the company. Some of those buying Motorola on the Matsushita news undoubtedly rushed in merely because the news was good and therefore could be expected to send the stock up. But there is reason to ascribe considerable buying to the belief that the financial community's appraisal of the company had been considerably less favorable than the facts warranted. The historical record was such that in the television business Motorola was regarded more as an also-ran than as an industry leader such as Zenith. With the television operations no longer blurring investors' vision of what else was there, a new image with a very much higher price-earnings ratio would arise. Were those who rushed in to pay these higher prices for Motorola wise in so doing? Not entirely. In subsequent weeks the shares lost the immediate gain so that a degree of patience would have paid. In downward markets, a change for the worse in the financial community's image of a company gets accepted far more quickly than a change for the better. Just the opposite is true in rising markets. Unfortunately for those who rushed in to buy Motorola on this news, the immediately ensuing weeks saw a sharp upturn in short-term interest rates which produced a downward trend in the general market and accentuated the widespread bear market psychology then prevailing. Perhaps another influence was also at work against those who snapped up Motorola shares overnight. This influence is one of the most subtle and dangerous in the entire field of investment, and one against which even the most sophisticated investors must constantly be on guard. When for a long period of time a particular stock has been selling in a certain price range, say from a low of 38 to a high of 43, there is an almost irresistible tendency to attribute true value to this price level. Consequently, when, after the financial community has become thoroughly accustomed to this being the value of the stock, the appraisal changes and the stock, say, sinks to 24, all sorts of buyers who should know better rush in to buy. They jump to the conclusion that the stock must now be cheap. Yet if the fundamentals are bad enough, it may still be very high at 24. Conversely, as such a stock rises to, say, 50 or 60 or 70, the urge to sell and take a profit now that the stock is high becomes irresistible to many people. Giving in to this urge can be very costly. This is because the genuinely worthwhile profits in stock investing have come from holding the surprisingly large number of stocks that have gone up many times from their original cost. The only true test of whether a stock is cheap or high is not its current price in relation to some former price, no matter how accustomed we may have become to that former price, but whether the company's fundamentals are significantly more or less favorable than the current financial community appraisal of that stock. As previously mentioned, there is a third element of investment community appraisal that also must be considered, along with its appraisal of the industry and of the particular company. Only after all three are blended together can a worthwhile judgment be reached as to whether a stock is cheap or high at any given time. This third appraisal is that of the outlook for stocks in general. To see the rather extreme effect such general market appraisals can have in certain periods and how far these views can vary from the facts, it may be well to review the two most extreme such appraisals of this century. Ridiculous as it may seem to us today, in the period from 1927 to 1929, the majority of the financial community actually believed we were in a new era. For years, earnings of most U.S. companies had been growing with monotonous regularity. Not only had serious business depressions become a thing of the past, but a great engineer and businessman, Herbert Hoover, had been elected president. His competence was expected to assure even greater prosperity from then on. In such circumstances, it seemed to many that it had become virtually impossible to lose by owning stocks. And many who wanted to cash in as much as possible on this sure thing bought on margin to obtain more shares than they could otherwise afford. We all know what happened when reality shattered this particular appraisal. The agony of the Great Depression and the bear market of 1929 to 1932 will be long remembered. Contrary in outlook, but similar in being spectacularly wrong, was the investment community's appraisal of common stocks as an investment vehicle in the 3 years from mid-1946 to mid-1949. Most companies' earnings were extremely pleasing. However, pursuant to the then current appraisal, stocks were selling at the lowest price-earnings ratios in many years. The financial community was saying that these earnings don't mean anything, that they were just temporary and would shrink sharply or disappear in the depression that must come. The financial community remembered that the Civil War had been followed by the Panic of 1873, which marked the onset of a very severe depression that lasted until 1879. Following World War I had come the even worse crash of 1929 and another 6 years of major depression. Since World War II had involved a vastly greater effort and therefore a greater distortion of the economy than World War I, it was assumed that an even bigger bear market and an even worse depression were on the horizon. As long as this appraisal lasted, most stocks were so much on the bargain counter that when it began to dawn on the investment community that this image was false and that no severe depression lay in wait, the foundations had been laid for one of the longest periods of rising stock prices in U.S. history. Since the bear market of 1972 to 1974 brought with it the only other time in this century when most price-earnings ratios were about as low as they were in the 1946 to 1949 period, the question obviously arises as to the soundness of the financial community's appraisal that brought this about. Are the fears engendering these historically low price-earnings ratios valid? Could this be another 1946 to 1949 all over again? An attempt will be made to throw some light on these matters in a later section of this book. There is a basic difference between the factors that affect changes in the general level of all stock prices and those that affect the relative price-earnings ratio of one stock compared to another within that general level. For reasons already discussed, the factors at any given moment that affect this relative price-earnings ratio of one stock to another are solely matters of the current image in the investment community of the particular company and the particular industry to which that company belongs. However, the level of stocks as a whole is not solely a matter of image but results partly from the financial community's current appraisal of the degree of attractiveness of common stocks and partly from a certain purely financial factor from the real world. This real-world factor is mainly involved with interest rates. When interest rates are high in either the long or short-term money markets, and even more so when they are high in both, there is a tendency for a larger part of the pool of investment capital to flow toward those markets, so the demand for stocks is less. Stocks may be sold to transfer funds to these markets. Conversely, when rates are low, funds flow out of those markets and into stocks. Therefore, higher interest rates tend to lower the level of all stocks and lower interest rates to raise that level. Similarly, when the public is in a mood to save a larger percentage of its income, more funds flow into the total capital pool and there is a more bullish pull on stock prices than when the pool of capital funds is rising more slowly. However, this is a much smaller influence than is the level of interest rates. An even smaller influence is the degree of fluctuation in new stock issues, which are a drain on the capital pool available to the stock market. The reason the new issue supply is not a bigger factor on the general level of stock prices is that when other influences cause stocks to be in favor, the new issue volume rises to take advantage of this situation. When common stock prices reach low levels, supply of new issues tends to diminish drastically. As a result, fluctuations in new issue volume are much more a result of other influences than an influencing factor themselves. This fourth dimension to stock investing might be summarized in this way: the price of any particular stock at any particular moment is determined by the current financial community appraisal of the particular company, of the industry it is in, and to some degree of the general level of stock prices. Determining whether at that moment the price of a stock is attractive, unattractive, or somewhere in between depends for the most part on the degree these appraisals vary from reality. However, to the extent that the general level of stock prices affects the total picture, it also depends somewhat on correctly estimating coming changes in certain purely financial factors, of which interest rates are by far the most important. Part 3. Developing an investment philosophy. Dedication to Frank E. Block. This book was first published at the request of the Institute of Chartered Financial Analysts made under the C. Stuart Shepard Award. This award was conferred on Frank E. Block CFA in recognition of his outstanding contribution through dedicated effort and inspiring leadership in advancing the Institute of Chartered Financial Analysts as a vital force in fostering the education of financial analysts, in establishing high ethical standards of conduct, and in developing programs and publications to encourage the continuing education of financial analysts. Origins of a philosophy. To understand any disciplined approach to investment, it is first necessary to understand the objective for which the methodology is designed. For any part of the funds supervised by Fisher & Co., except for funds temporarily in cash or cash equivalents awaiting more suitable opportunities, it is the objective that they be invested in a very small number of companies that, because of the characteristics of their management, should both grow in sales and more importantly in profits at a rate significantly greater than industry as a whole. They should also do so at relatively small risk in relation to the growth involved. To meet Fisher & Co. standards, a management must have a viable policy for attaining these ends with all the willingness to subordinate immediate profits for the greater long-range gains that this concept requires. In addition, two characteristics are necessary. One is the ability to implement long-range policy with superior day-to-day performance in all the routine tasks of business operation. The other is that when significant mistakes occur, as is bound at times to happen when management strives for unique benefits through innovative concepts, new products, etc., or because management becomes too complacent through success, these mistakes are recognized clearly and remedial action is taken. Because I believe I best understand the characteristics of manufacturing companies, I have confined Fisher & Co. activities largely to manufacturing enterprises that use a combination of leading-edge technology and superior business judgment to accomplish these goals. In recent years, I have confined Fisher & Co. investments solely to this group, because on the few occasions when I have invested outside it, I have not been satisfied with the results. However, I see no reason why the same principles should not be equally profitable when applied by those with the necessary expertise in such fields as retailing, transportation, finance, etc. No investment philosophy, unless it is just a carbon copy of someone else's approach, develops in its complete form in any one day or year. In my own case, it grew over a considerable period of time, partly as a result of what perhaps may be called logical reasoning, and partly from observing the successes and failures of others, but much of it through the more painful method of learning from my own mistakes. Possibly the best way of trying to explain my investment approach to others is to use the historical route. For this reason I will go back into the early, formative years, attempting to show block by block how this investment philosophy developed. The birth of interest. My first awareness of the stock market and the opportunities which changing stock quotations might make possible occurred at a fairly early age. With my father the youngest of 5 and my mother the youngest of 8, at my birth I had only one surviving grandparent. This may have been one of the reasons why I felt particularly close to my grandmother. At any rate, I went to see her one afternoon when I was barely out of grammar school. An uncle dropped in to discuss with her his views of business conditions in the year ahead, and how this might affect the stocks she owned. A whole new world opened up to me. By saving some money, I had the right to buy a share in the future profits of any one I might choose among hundreds of the most important business enterprises of the country. If I chose correctly, these profits could be truly exciting. I thought the whole subject of judging what makes a business grow an intriguing one, and here was a game that if I learned to play it properly would by comparison make any other with which I was familiar seem drab, meaningless, and unexciting. When my uncle left, my grandmother turned to me and said how sorry she was that he happened to come in when I was there, forcing her to spend time on matters which could not possibly interest me. I told her that, to the contrary, the hour he spent with her had seemed like 10 minutes, and that I had just heard something that interested me tremendously. Years later, I was to realize how very few were the shares she owned and how extremely superficial were the comments I heard that day, but the interest that was kindled by that conversation has continued all during my life. With this degree of interest and in a period when most businesses were far less concerned with the legal hazards of dealing with minors than is the case today, I was able to make a few dollars for myself during the roaring bull market of the middle 1920s. I was strongly discouraged from this, however, by my physician father, who felt that it would simply teach me gambling habits. This was unlikely, as I am not by nature inclined to take chances merely for the sake of taking chances, which is the nature of gambling. On the other hand, as I look back upon it, my tiny-scale stock activities of that period taught me almost nothing of any great value so far as investment policies were concerned. Formative experiences. Before the great bull market of the 1920s was to come to its crashing end, I did have an experience, however, that was to teach me much of real importance for use in the years ahead. In the 1927-28 academic year I was enrolled as a first-year student in Stanford University's then fledgling Graduate School of Business. 20% of that year's course, that is 1 day a week, was devoted to visiting some of the largest business enterprises in the San Francisco Bay Area. Professor Boris Emmett, who conducted this activity, had not been given this responsibility because of the usual academic background. In those days, the large mail-order companies obtained a significant part of their merchandise through contracts with suppliers whose sole customer was one or the other of these firms. These contracts frequently were so hard on the manufacturer and afforded him so little profit margin that from time to time a manufacturer would find himself in severe financial difficulty. It was not in the interest of the mail-order houses to see their vendors fail. Professor Emmett had for some years been the expert employed by one such mail-order firm with the job of salvaging these faltering companies when they had been squeezed too tightly. As a result, he knew a great deal about management. One of the rules under which this course was conducted was that we would visit no company that would just take us through the plant. After seeing the wheels go around, the management had to be willing to sit down with us so that, under the very shrewd questioning of our professor, we could learn something of what the strengths and weaknesses of the business really were. I recognized that this was a learning opportunity of just the type that I was seeking. I was able to jockey myself into a position to take particular advantage of it. In that day, over a half-century ago, when the ratio of automobiles to people was tremendously lower than it is today, Professor Emmett did not have a car. I did. I offered to drive him to these various plants. I did not learn much from him on the way over. However, each week on the way back to Stanford, I would hear comments of what he really thought of that particular company. This provided me with one of the most valuable learning experiences I have ever been privileged to enjoy. Also on one of these trips I formed a specific conviction that was to prove of tremendous dollar value to me a few years in the future. It was actually to lay the foundation for my business. One week we visited not one but two manufacturing plants that were located next door to each other in San Jose. One was the John Bean Spray Pump Company, the world leaders in the manufacture of the type of pumps that were used to spray insecticides on orchards to combat natural pests. The other was the Anderson Barn Grover Manufacturing Company, also world leaders, but in the field of equipment used by fruit canneries. In the 1920s the concept of a growth company had not yet been verbalized by the financial community. However, as I somewhat awkwardly worded it to Professor Emmett, I thought that those two companies had probabilities of growing very much beyond their present size to a degree that I had seen in no other company we had visited. He agreed with me. Also, through spending part of the time on these automobile trips by asking Professor Emmett about his previous business experiences, I learned something else that was to stand me in good stead in the years ahead. This was the extreme importance of selling in order to have a healthy business. A company might be an extremely efficient manufacturer or an inventor might have a product with breathtaking possibilities, but this was never enough for a healthy business. Unless that business contained people capable of convincing others as to the worth of their product, such a business would never really control its own destiny. It was later that I was to build on this base to conclude that even a strong sales arm is not enough.